is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
The labor market is showing some weakening. It's had considerable cooling taking place.
The labor market is not necessarily on the precipice of breaking. We have seen a loss of momentum, but we're still talking about a circa 4% unemployment rate.
I don't know if unemployment is going to stay there or not. It often moves up slowly and then moves up rapidly.
We think unemployment probably ends around where it is now. The labor markets are normalizing.
Labor market renormalization should not be mistaken for any labor market weakness.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the payrolls report, the second hour of Bloomberg Surveillance starts right now. Let's start with the price action, and then we can turn to the estimates. The price action, negative. It continues on the S&P 500. We're down across the board, down by more than 1 full percentage point on the S&P. On the NASDAQ, down by 1.6. On the Russell, the small caps, down by 1.9. At the bond market, the rally continues for a 7th consecutive session. Yields lower over that period by more than 30 basis points on a 10-year maturity. The 2-year dropped 50 in the month of July alone. That move continues. Yields lower at the front end by 3 basis points, 4.12 on 10 to break of 4% in the last 24 hours. Your 10-year, 3.94. I promise you the estimates, so here they are. Going into payrolls, just around the corner. 175 is the median estimate in our survey. On unemployment, 4.1%. The question, particularly after the weakness of yesterday, ISM manufacturing, jobless claims, is this a head fake or the real deal? With us around the table, the real deal, Mohammed Al-Aaron of Queen's College, Cambridge, with us for the next 2 hours. Alongside Anne-Marie, I'm Jonathan Farrow. Mohammed, we've got to go to you first. Head fake or the real deal? What is this?
I think the U.S. economy is slowing faster and in a broader sense than most people anticipated, including the Fed. And I think that the market is catching up to that possibility, which has become a probability.
So I've said repeatedly, I've asked repeatedly, welcome cooling or unwelcome deterioration. Is this starting to sound more like the latter than the former?
It is the latter. There's no need for us to have an excessive slowing in the economy. This remains quite a robust economy. And if we do get it, it is because the Fed was late in recognizing that the economy is slowing.
Now there's a debate if the Fed needs to cut deeper when they go in September. Do you think that they should, in September, go to 50 basis points instead of 25?
I think if they go to, I'm laughing because so many people now are starting to say 50 basis points. To start with a 50 basis points cut means you've made a policy mistake. And this is a Fed that surprised a lot of people by having to hike 4 times in a row by 75 basis points. So they were late starting, and if they cut by 50, they will signal that they're late starting to cut. I think it would be a mistake to cut by 50, but the fact that some people are talking about it, I think, is where the information content is right now.
We've got lots of time with you this morning. You'll be with us through the 7 o'clock hour into the 8 o'clock. We'll go through the jobs number together. I just want to sit on what I think has been the biggest piece of your call, which is listen to corporate America. It worked the first time. It seems to be working the second time. What did you make of the tone of that news conference with Chairman Powell early this week, where he appeared to dismiss any evidence, any signs of weakness?
So I think he was trying to strike that delicate balance, first explaining why it is they didn't cut, but signaling that they're likely to cut. And he on the whole, actually, he struck it quite well. He did come across more dovish than the statement, and you saw the market react in that way yet again, and that is his habit of coming across more dovish. But I understand, you know, it's not like the Bank of England. The Bank of England is very clear. 5 people voted for, 4 people voted against.
Yeah.
You know it's very... He responded by saying, oh, no, it's really good that everybody votes the same way. Actually, it's not good that everybody votes the same way because you don't get a sense of how difficult this judgment call is.
I wonder if we get a sense of that in these speeches over the next few weeks from Fed officials. Mohammed's going to stick with us. Your lineup for the next hour, Priya Misra of JP Morgan. As weak data spooks bond investors in the last 24 hours, we'll catch up with Ed Mills of Raymond James as Kamala Harris prepares for a swing state tour. And we'll catch up with Nita Richardson of ADP, looking ahead to the jobs number. We begin with our top story, weak data fueling a bond market rally going into the latest US payrolls report. Priya Misra of JP Morgan writing this, given recent data, all markets are getting a little nervous about a recession, and I think we'll react more to a downside surprise. The labor market is softening, and we are all focused on whether it is slowing to trend or below. Priya joins us now for more. Priya, it's good to see you. Let's get this conversation started. We've got a lot of work to do. We've had a massive rally in the bond market. What's the limit of this rally, given the move we've already seen at the front end of the curve on a 2-year and further along the curve on a 10-year?
So I think if the soft landing persists, I mean, we've talked about how narrow that path is. I think it got narrower in the last few weeks. But if we remain in the soft landing, I think rates are pretty fairly priced. I mean, the 10-year, 375, 4.25. We were kind of right in the middle of that. If the economy slows down more, there's a lot more room. I mean, look at the end point. We're also focused on when do they start? Do they go 50 or not? Look at the end point. We're priced for 3.2. That, to me, is a soft landing terminal rate. If the economy slows down and the Fed realizes, well, maybe they should have cut earlier, they need to cut faster, they're going to cut a lot below that. So I think then you're talking about the 10-year getting closer to 3%. I don't think we're there yet. So which is why the data over the, I mean, end of cycle data is always difficult. You're getting mixed signals. You have to, you know, figure out the signal from the noise. But if the economy starts to weaken, bond yields are going a lot lower, particularly in that front end, because we should start to price in the Fed taking rates into not just neutral rate, but sort of into accommodative territory.
Priya, you just mentioned that the balance of risk for the employment report coming up is that it's even weaker than what people anticipated. There's the other view, look how much bond yields have moved. The balance of risk is the other way around. The technicals now have changed completely in the market. So how do you judge the balance of risk for today's numbers?
So I agree. We've had a really big move this week. So if you get a 200, 250, I think we should also debate what is break even. You know, back in the day, we would think 100,000 was break even. I would argue it's closer to 200,000. So if you get a 300,000 payroll number, absolutely, I think rates can rise. We can give back some of the move this week. But here's the thing. We're debating whether the labor market is slowing to trend or it is slowing. Unequivocally, the economy is slowing. The labor market is slowing. So we're not talking about rate hikes. So I think it limits how high the 10-year can go, how high the front end can go. The Fed is getting ready to cut rates. I think it's a series of cuts because here's what's fascinating. The Fed, Chair Powell has said it multiple times, the labor market is back to where it was pre-pandemic. Look at where monetary policy is significantly restrictive. So I would argue, even if, let's say the economy is not slowing that much and we stay in the soft landing, the Fed has a lot of room to get rates to neutral. Maybe it's 3, maybe it's 3.5. It's not 5.5. So I think it's still somewhat asymmetric.
So how quickly should they be going there? Are you in the 50 basis point cuts in September?
So I would like the Fed to cut 50, start the process. Look at the starting point. I don't think they're going to get there because it's going to spook the market. What does the Fed know that we don't know? So I think they start 25, but I think we should take them at their word. Things slow down more. The unemployment rate rises to 4.5. I think they speed up. Just like the hiking cycle, remember, was not a series of 25 years. You said 25, 50, and then a series of 75s. You might have the cutting cycle, and I think the cutting cycle is going to look very similar, where they start slow, and then if things worsen, they're going to really crank it up.
So that means September, November, and December.
I don't understand the let's go really slowly. If the economy is back to normal, get monetary policy to normal quickly. And I think the market's starting to price that in. What we've done is we haven't taken down, the market has not taken out terminal rate estimates that much. They've moved the cuts into 24 and 25. That makes sense. If you want to normalize policy, go every meeting, go 25 every meeting, and that gives you the option that if things start to slow down, you can really, start to accelerate.
You write that the market will react to a number below 150,000. We had Kit Juke, Sarah House on the last hour. They said below 100,000 would really be a dramatic market move. What do you think would be so low that really starts to unnerve the Fed and maybe we would see a bigger cut in September?
I think below 100 will do it. And it's the totality of data. So we've got the claims number. It's the best high-frequency measure of the labor market. It's been inching up. So if that continues, I think you could start to think the Fed, and again, the Fed can try and finesse the message by saying we're at 5.5. So we're not panicking, we're not going to zero, but we're just normalizing. The 50 is just the start of normalization. We know monetary policy works with a lag. I mean, that's the one thing we've all learned. We've lived through the lags, these long and variable lags. But I think, yeah, if you get a below 100, Joel's continuing to fall, ISM services, that ISM manufacturing was scary. If services is also that weak, I think then that 50 talk just gets a lot louder.
What was scary about it? What component of it really spooked you yesterday?
I think new orders, employment, a lot of, we know manufacturing is weak, and that's why I'm waiting really for services, because the economy is not really a manufacturing economy, but it tends to be, ISM manufacturing tends to be more cyclical, tends to lead the move. So the broad-based slowdown and, at cycle lows, you start to worry, is that a leading indicator? And we've been getting a bunch. Here's why you don't want to overreact, because you look, is there overinvestment in any sector? Not really. Corporate balance sheets look healthy. So, which is why I think we're still in a soft landing. But soft landings are all about risk management, and the risk management now, I think, argues for hedge that downside.
So help me understand, 2 to 3 weeks ago, the narrative was they have plenty of time, the economy is fine, of course they won't cut in July. Now suddenly, they should have cut in July, they could do 50 in September. What has changed? What is it that has made this narrative change so radically?
So markets do tend to overdo things, or maybe there's an element of that here. But I will say, if you look at the inflation data, we've seen very welcome slowing. The only thing that's high is really shelter. And you look at the totality of data, that one thing that was holding all this up was the job market. That's showing signs of slowing. Again, I think we don't know enough whether it's slowing to just, are we going to normalize? And that's the big question we're all facing. Is this normalization? Chair Powell said it many times. I think he hopes, we all hope this is normalization. But labor market slowdowns are often non-linear. So if the unemployment rate starts to rise, does it just rise a lot faster? And then what does a 25 basis point cut do? I think that's why the market, and I'm hoping they can be a little fast, get to some sort of normal level, neutral, whatever that is, and then they can respond better. At least reduce the level of restrictiveness. We have very restrictive policy right now.
Let's get to the calendar. August 2nd today, jobs report. August 14th, CPI report. September 6th, first Friday of that month, we'll get a jobs report. September 11th, we get a CPI report. September 18th is a Fed decision. And that Fed decision is not just about interest rates or the news conference, it's about new projections. And you talked about finessing the message. They've got to finesse the forecast, don't they? The unemployment rate they've got for year-end for 2024 is 4%. The unemployment rate they've got for year-end 2025 is 4.2. And there are some people who think we might be there today in about an hour and 20 minutes. Now, I wonder what that looks like in September. What does that get revised to?
I think the projections are a function of appropriate monetary policy. So we should look at the dots along with the projections. They might keep the projections at 4.2 and just speed up the rate cuts. Because if they think that monetary policy will work, they can cut rates and keep us in the soft landing. And so you may not have a big increase in the unemployment rate. What would worry me a lot is if they have an increase in the unemployment rate and they don't have a lot more cuts. That means they're telling you they're okay with a slowdown. That's not what Chair Powell's saying. So I do think they're going to hope that they can cut in order to keep us there, but that's the big question. Are we less interest rate sensitive today? And I would argue we are, and we need time for interest rates to work. So if they don't start fast, that unemployment rate's going up.
You think even if they do start cutting, it's not going to be enough to slow this down?
It's tricky. I think we don't know, but we should think about the scenario where they cut even 50s at 5.5. If they're cutting 50 a quarter, or even, I think 50 a meeting, you might just about get there. Stop QT. It's odd that they're also doing QT on the other side. That's tightening monetary policy. They need to ease, unless you get big fiscal easing, and that's the other. We're on a knife edge right now. The economy, the elections. So there's a lot of unknowns, but I think we should be looking at the outcome where you don't get any more fiscal easing and monetary policy is adjusting too slowly.
Priya, it's great to catch up with you. Priya Misra of JP Morgan. Mohammed, on the money as always, how quickly this conversation has changed in a couple of months.
I'm stunned. I'm absolutely stunned how quickly it has changed. And a lot of what you said, Priya, we knew. We knew that monetary policy adds with a lag. We knew all this stuff, but it's amazing how the market has gone from lower interest rates to good thing for credit and for equity risk, to lower interest rates signals something really bad for credit and equity risk.
That's a major change as well in this conversation. This bond rally continues. Equities are still selling off. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. ExxonMobil reported earnings that beat expectations. Shares just up 0.7%. The company's acquisition of Pioneer Natural Resources pushed oil and nat gas output to a record. It does provide assurance to investors that Exxon is well placed to push through its planned 15% ramp up in share buybacks that would put it to $20 billion a year. Exxon is the best performing major oil stock so far this year. Now, Politico is reporting that chip maker NVIDIA is facing antitrust investigations. The probe is focused on the company's business practices and the acquisition of a startup called Run AI. Run AI helps users do more processing with fewer chips. Regulators, though, want to know if NVIDIA is just simply buying the company in order to bury it. Both the DOJ and Run AI did not comment when asked by Politico. And JP Morgan CEO Jamie Dimon writing in a Washington Post op-ed that the private sector should, quote, have a seat at the table in a future presidential cabinet. Dimon writing, a president should put the most talented people, including those from business and the opposition party, into their cabinet. The editorial leads with the call for, quote, strong American leadership to bolster U.S. influence and strength, saying the country is at an inflection point and that could determine the fate of free and democratic nations for decades. And that's your brief, John.
Danny, thank you. That's the sound of Priya running out of the room with no comment. Up next, new dynamics in play for November.
The common theme, in my view, is this sort of populism that has taken on a very nationalistic fervor. Even if the other side, if Kamala Harris were to win, she's not Joe Biden. So let's see what that means.
The conversation's up next, live from New York City. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
If you are just tuning in, welcome to the program. Pulling back a little bit on the S&P 500. I say a little bit because we've got used to these kind of moves in the last 24 hours, haven't we? We're down by 1.2% on the S&P. The rally continues in the bond market. Yields are lower by 4 basis points. A break of 4% yesterday. 493.57 on a 10-year going into payrolls later this morning. Under surveillance this morning, new dynamics in play for November.
The common theme, in my view, is this sort of populism that has taken on a very nationalistic fervor, and our country is not immune from that either. I look at the left, and they have always been about populism versus business and Main Street. We're going to be set up in the Republican Party for a real debate now going forward. There is no incumbent running. So even if the other side, if Kamala Harris were to win, she's not Joe Biden. So let's see what that means.
It's the latest. The Harris campaign announcing a record-breaking fundraising haul of $310 million in July. That's more than double the nearly $140 million that Donald Trump's campaign pulled in. Ed Mills of Raymond James has this to say. Harris's campaign launch arguably could not have gone better for her, but we're on the cusp of her first major governing decisions with her selection of a vice president. Ed joins us now for more. Ed, we've got some time this morning to go through the VP stuff. I want to start with this column in a Washington Post this morning. I'm sure you've seen it, Ed. It's from Jamie Dimon of JP Morgan. I'll share the quote with you so our audience who are just joining us can see it as well. The private sector has huge wells of expertise and produces 85% of our nation's jobs. It should have a seat at the table. Yet in recent years, government leaders have often failed to engage those in industry. A president should put the most talented people, including those from business and the opposite party, into their cabinet. Ed Mills, is that wishful thinking from the CEO of JP Morgan?
Well, John, I think it depends on who wins. I think there has been a frustration in D.C. I've talked to a number of folks within the financial services industry where they feel as if experience with an industry is actually something that makes it almost impossible to get Senate confirmation on any position that requires to go through the Senate Banking Committee where Elizabeth Warren serves. I do think that Jamie Dimon is setting up to possibly be a Treasury Secretary in a Trump administration. And one of the big debates that I've had with clients at Raymond James is if Trump wins, will there be people that join his cabinet, join his administration that the market likes, like we saw back in 2016? And I think op-eds like the one this morning, John, say the answer is most likely yes. And I do think, to former Majority Leader Cantor's point, Kamala Harris is very different from Joe Biden on a lot of things. And personnel equals policy. I do think she would be more open to certain individuals serving in the administration. A big debate over does FTC Chair Lina Khan stay? Her term expires in September. Or would she put in someone that is more tech-friendly, given the fact that she's the former senator from California and has strong ties within the tech industry?
Ed, why do you think it's a Treasury Secretary position under Trump? He doesn't mention Trump or Harris in this op-ed. And we've seen this individual talk badly about Trump openly, but also give him credit when credit is due. It's not like he is very obvious about which team he's playing for.
Sure. I think I make those comments based upon what he said back in Davos, where he seemed to open up this opportunity when we've gone through possible list of Treasury secretaries. We put him on the list in the Trump election. I would not have put him on the list in a Biden re-election. I think it's a maybe should Harris win. So, Anne-Marie, it's an important point. I just think that given some of the comments that he's made, it's slightly more likely. And talking about having someone from the other team, Dimon is viewed kind of in D.C. as a Democrat. So the other team would be the Republican Party.
Based on the comments we've seen from him repeatedly, I think he'd say the team he's on is the United States. And that's the point he's trying to make in the piece this morning. Ed, the difficulty I have with the vice president, and I think a lot of people do, and it's still early days, and we'll find out more about her position on a range of things, And it's difficult to understand what she actually stands for, what the policy platform will be, because as far as we understand at the moment, there's been some distance created between her and the sitting president, some distance created between her and her views back in 2019 when she was running for 2020. What's your understanding of what this policy platform might look like?
Yeah, John, so first and foremost, I think it's easy for her to say that this is a continuation of the Biden-Harris administration, should she win. And the Biden administration would point to the different successes that they've had on the Inflation Reduction Act, the bipartisan infrastructure bill, and what Biden was trying to make as a campaign promise for his second term is the full implementation of those. So that's where we start. But you are right. She was only in the Senate for a relatively short period of time compared to what we've had for other candidates. With Donald Trump, we've had him as president for 4 years, so we have a much greater understanding. When we go back to her time as Attorney General of California, what stands out the most is her settlement with 50 attorneys general on a foreclosure settlement against the largest banks in this country. But besides that, it's a lot of things that are popular within the Democratic base. She has led on reproductive rights. But in politics, what I've always said is that when you're explaining, you're losing. So right now, she is in a honeymoon period of her campaign to go out there and launch that 10-point plan to go through kind of the details. They think that that gets her into the explaining part of the conversation. They'd rather have the honeymoon last as long as possible. So the fewer policy details you give today, the easier it is for the honeymoon to continue versus really going through this conversation as to why did the comments about fracking or Medicare for all back in 2020 could be so different than today? Well, a lot of that's because states like Pennsylvania are probably the tipping state, and it makes it much harder to win in swing states, win in states that have a lot of fracking, if you keep those former positions. So just allow the kind of independent validators to make your case and step back and see how long it can be until you have to take some of these positions.
Ed Mills of Raymond James. Ed, thank you. Appreciate the update. Mohammed, you've been following this conversation. You've been following the news over the last few weeks. What do you make of all of this? What's your view of things currently?
So I think that the vice president's campaign is gaining traction much faster than anybody anticipated. Ed didn't mention the $310 million in July that she raised. That's a lot of money, and that's quite a reaction from the base. So suddenly we've got a really interesting race going on.
I've heard this phrase repeatedly, Anne-Marie. Honeymoon, VP pick, honeymoon continues. Keep going to these campaign rallies, big audiences, drum up all that enthusiasm. And then we get to the explanation, the explaining, as we get closer and closer to the DNC.
The DNC obviously is going to be this celebration. They're going to have a ticket, and then the real election starts. You really will have, she'll have to sit down, she'll have to answer in an interview policy questions. If she wants to win Pennsylvania, she needs to decide whether or not she wants to ban fracking or not. Yep. That's going to be replayed constantly on Trump ads.
I go back to what Libby Cantrell told us all, good friend of all of ours. Get a cocktail, go to the beach, and come back on Labor Day, after Labor Day, all right? And then we'll talk about politics. From New York, this is Bloomberg.
Britain's next.
It was going to keep reading World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
So if you thought July was exhausting, welcome to August. Here we go. Check this out. Down by more than 1% across the board. On the S&P 500, negative by 1.2. On the Nasdaq 100, down by 1.7. On the Russell, the small caps, up 10% in July, down 2% this morning. We are heading towards a third week of losses on the S&P 500 unless we get a turnaround sparked potentially by a payrolls report dropping in about 60 minutes' time. Switch on the board, turn a page, and let's get into the bond market. We'll sit on the 2-year and a 10-year. Let's start with a 2-year, down to 4.1%. We're down 4 basis points. We were down 50 in July. We add to that move. We dropped 4 on a 10-year, 7 consecutive sessions. This maturity has been rallying. Over that period, that yield has dropped by more than 30 basis points. We're down 5 this morning to 392.81 after breaking through 4% for the first time since spring of this year. I want to turn to foreign exchange. As yields drop, we've engineered this massive unlocking of yen strength, promoted and endorsed and encouraged by what we heard from the BOJ earlier this week as well. We're through 150, we're down to 148.93, we're down about a third of 1%. Dollar yen down for a 5th consecutive week. That is another week of yen strength, and that has unlocked some real weakness in the Japanese equity market. Take a look at the top picks, the Nikkei 225, pick your poison. It's all poison. Over the last 2 days, we're down hard by something like 8% on the Nikkei 225. Mohammed, we're down by almost 6% in today's session. What do you make of what's developing, not just in the United States, but worldwide in places like Japan? Because it hasn't just been a US market move, it's been global.
Yeah, but I think Japan is an outlier, and that's why you're seeing the much bigger move, because the equity market there is having to cope both with a weaker currency, with a stronger currency, and higher rates. And these two things are adding or amplifying the pressure that's coming from outside. Ironically, that's what they needed to do. They really did need to normalize faster, and we got that message clearly this week when the governor said that a weak currency is problematic for inflation, and he sees no limit, no ceiling to that. So it doesn't surprise me. They are doing something they should have done earlier, which is normalize at a faster rate.
Based on the guidance we got from Governor Ueda, it looks like the bar to go again is pretty low, looking for another rate hike. We spent a number of months this year talking about the prospect of central bank divergence, and at the time we were talking about the ECB versus the Federal Reserve. I'm wondering more now about the BOJ versus the Federal Reserve, real pure divergence. How far do you think that could extend?
I think in that case it could extend quite far. What I think cannot extend that far is between the Fed and the ECB, the Fed and the Bank of England. That trades in a similar world. But with Japan, divergence could extend quite far.
Dollar yen right now, 148.97. We're negative on that currency pair by about 1/4% or so. That's the price action. I just want to turn to some top stories for you. Under surveillance this morning, let's start with this one. President Biden vowing more U.S. support to Israel. This coming as Israel faces fresh threats following the assassinations of Hamas and Hezbollah leaders. At the same time, Biden pressing Netanyahu to move forward with ceasefire efforts. How much progress are we going to see in the next few days?
Well, I think what is interesting is you see Biden really leaning into foreign policy issues right now. He is a lame dunk president. If he's going to have any legacy in the next few months, it's going to be to try to shore up some of these deals, try to put a bow on some of these negotiations he's been working on. What I find interesting is this comes after Ismail Haniyeh was assassinated. So Biden also said when he was briefing reporters that Israel should take this deal, they should move on it fast. He said that it hasn't helped that this individual was assassinated. So potentially got on the phone with Netanyahu to say, yes, we're going to send you more material, but what you did actually didn't help in these negotiations. Also, what I find interesting, the end of May, Biden came out with this ceasefire proposal, and I looked up the text this morning because he's saying Israel should move on it. Biden presented the ceasefire proposal at the end of May saying Israel has now offered Israel has offered a comprehensive new proposal. Well, which is it? Is the United States pressuring Israel to take this proposal, or was it the end of May Biden saying this was Israel's proposal that they've outlined this 3 steps?
Kamala Harris is not exactly known for her foreign policy expertise. How closely is she going to be aligned with the president in the coming days on this issue, the coming weeks, the coming months for the rest of this campaign?
If he gets a ceasefire negotiation, she's going to want to bask in that, and that's going to be very helpful when it comes to young voters and progressives. But you have seen her try to take a slightly different tone when it comes to Netanyahu, and that's obviously especially important with Democratic politics heading into November. And you saw last week she had a separate meeting with Benjamin Netanyahu. So Netanyahu comes here, and he has 3 different meetings: Biden, Harris, and Trump, because November 6th, it does not unclear who he's going to get, but he still needs to deal with the sitting president at the moment.
I think we're all trying to figure that out, that's for sure. I want to turn to China and talk about Apple. So Apple's seeing some poor sales in China, despite a generally upbeat earnings report from one of the biggest companies on the planet. The company predicting that its new AI features will spur iPhone upgrades in coming months. It's a different story for Intel, the company delivering a grim growth forecast and plans to slash 15,000 jobs. Mohammed, let's start with Apple and a weakness in China. They would attribute this to the FX market and the strong US dollar, and perhaps we can run with that argument. But we've seen this repeatedly in China over the last few weeks from corporate America, and I would say from corporations worldwide. What can they do to address this weakness? Because what we hear, particularly over the last week or so, is that they've got some room to move on the fiscal side, but they want to wait to see what happens in the election before they do it. They want to keep that dry powder for 2025. What's your interpretation of what's developing there?
So unfortunately, China is going back to its old game of trying to use the global markets to turbocharge their own growth. And we see this in exports, we see this in the currency. What they need to do, and I think they know that, is they need fundamental reforms. And they understand what sort of reforms they need. They need to develop new engines of growth. And right now, they do not want to suffer the consequences of structural reforms. And what are the consequences? The benefits are long-term, the costs are upfront. So what you're seeing them is going back to some old place. Look, China is going to be slower for longer. People, I don't think, fully realize this. Apple has an extra disadvantage. It's an American company. So you are looking at 2 headwinds for American companies. One is from the economy, and 2 is from the fact that China is slowly diversifying away from American companies. The Chinese consumer is diversifying away.
That's the important point here. The Chinese consumer is backing away. Is that a trend that you think has legs? Is that going to be difficult for American companies that are ultimately looking at China, have a big presence there, and are looking to sell to that Chinese consumer?
I think any American company that's not putting this into its growth projections is making a mistake. Yes, that's going to be around for a while.
That's corporate America. Can we talk about companies that have to engage, countries that have to engage on this issue as well? I remember an opinion column you wrote maybe a number of years ago, and you talked about the fence sitters, the countries that wanted the security blanket from America and at the same time wanted to have that presence in China. How sustainable is fence sitting in the world that we're going into now?
So it depends who you are. If you're India, if you're Brazil, if you're Saudi Arabia, if you're the United Arab Emirates, fence sitting is sustainable. You can play both sides. Why? You've got something special. If you're New Zealand, Australia, Singapore, Mexico, fence sitting is not a sustainable approach. And then you've got a third category that we never talk about, is that countries that are going to be left out completely. Think of some countries in Africa. So what you're going to see is the middle powers, some of them being able to fence sit. A second category will be forced to make a choice at some point, and then a third category that get the worth of both sides.
What about a fence sitter like Germany? Pressured by the United States. Are they a fence sitter? They're pressured by the United States to put up the walls, yet they're desperate to be in the Chinese market.
Yeah, I don't think they're going to be a fence sitter long term. And Italy is another example where the Prime Minister is trying to fence sit. I think ultimately Europe is going to align on national security rather than economic.
Interesting. That's the latest on China and Europe. Let's turn to this. I want to get to Amazon earnings and the latest from big tech, delivering some disappointing results, telling investors that profits for now will take a backseat to heavy AI spending. The company also providing conservative revenue guidance for the third quarter as well. This was a line that came from the CFO. We're seeing a lot of the same consumer trends that we've been talking about for the last year. Consumers being careful with their spend, trading down, looking for deals. Poonam Goyal of Bloomberg Intelligence joins us now for more. Poonam, we have heard this repeatedly. And Mohammed Alarin, who's with us around the table, has talked about this repeatedly as well. P&G, slower price increases. Kimberly-Clark, slower price increases. Pepsi, consumers more challenged. Internationally, Nestle, value-seeking behavior. Poonam, how is Amazon dealing with that at the moment?
You know, Amazon's focused on price, so you're absolutely right. The consumer remains selective. They're trading down and they're playing for value. And in that instance, Amazon has to discount more. And we saw that over Prime Day just recently. And we expect them to continue to push the pedal on price, which is in part of the reasons for their weaker operating margin guidance for the third quarter.
Poonam, I want to focus a little bit on all the investments that we're hearing about. And what that does to the structure of the industry. So if the big ones, if the mega companies are investing so much money, what happens to the belly of the curve? What happens to the mid-sized companies that are trying to establish a footing here?
I think, you know, the bigger you are, the more power you have to invest, the more capital you have. So you're going to grow faster. When it comes to the smaller, the middle companies, I think they're going to have to find a way to lease some of this infrastructure, some of this technology investments, because they don't have the capital to invest like an Amazon or even a Walmart. And I think they will be challenged, and we're seeing that already. You know, the investments that Amazon, eBay has made in technology and AI, many of the other retailers that I follow, they're nowhere near that today. So they're scrambling, they're picking and choosing where they invest, taking small pockets of opportunity.
So what do you tell people in Washington that are concerned about consumer protection, that are concerned about competition, that are seeing a natural tendency for the big to get bigger and the smaller to get squeezed?
I think they have to, you know, figure out the big can't get bigger through acquisitions anymore. It's very hard for an Amazon to buy something today. So the growth is all organic. That said, you know, will there be pressure from Washington on allowing companies like Temu and Shein, which are creating this added pressure, especially on the consumer side, right? With these rock bottom prices, it's really challenging everyone, not just the big, but also the mid and the small sized businesses, because you can't compete with those prices unless you're big and you can afford to take the loss.
The Amazon CEO, speaking to investors, said that it's a pretty tough experience with how much is locked behind cabinets. Currently, he's talking about U.S. drugstores. We have to press a button to get somebody to come out and open the cabinets for you, and shoplifting going on in the store. How much are the issues that Americans face at drugstores actually benefiting Amazon right now?
So Amazon benefits largely from convenience. And yes, it is a little uncomfortable to, you know, have to go into a store and have to ask someone to open up these cabinets. It's not the best shopping experience. And we are seeing the shift to online really help with that. But that said, it depends on when you need it and how you need it, especially when you're at a drugstore. If you need your medicine in the next 30 minutes, in the next hour, you're going to walk into a CVS or somewhere else. But if you can wait a day, then you can go to Amazon and have it fulfilled, or to any other online retailer.
The retail experience with some of these companies, Anne-Marie, dead on. It's awful. You don't want to go in there. Why would you?
And the CEO is saying the combination of what's happening in the physical real world and how much progress Amazon is making in their e-commerce pharmacy is helping them tremendously, because people don't want to wait around 10 minutes and then have the sales attendant hover over you while I decide which deodorant to buy.
To Poonam's point, you know, you get out the phone, order the toothpaste, put it back down and walk away. Do I want to go into name your franchise, whatever it might be, and get them to unlock the thing to get the toothpaste out? Who wants to do that anymore? It's ridiculous.
Not when you have the convenience of Amazon. A lot of people aren't. They're stealing their market share.
Big time. I mean, literally, stealing. Poonam Goyal at Bloomberg Intelligence. Poonam, thank you. Appreciate it. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Speaking of not wanting to shop in physical stores, DoorDash shares are up 9.5% pre-market. They reported a stronger than expected profit forecast for the current quarter, and that defied the consumer slump elsewhere. Analysts praised its resilient demand and growth from categories beyond restaurant orders. It expanded its marketplace to include items, again, like grocery, beauty, home improvement, and sporting goods. Now, there's a bit of bad news for bankers in London. Say goodbye to your business class flights. According to Bloomberg reporting, travel is the latest target for UK lenders trying to cut costs. At Standard Chartered, employees now must fly economy for flights under 5 hours. At Lloyd's, they're being told to take public transportation instead of taxis. And at HSBC, employees can only book work travel if they've set up at least 3 meetings a day for that trip. And Andy Murray has ended his tennis career with a quarterfinals defeat in men's doubles at the Olympics. The multi-Grand Slammer jokingly posted on X that he, quote, never liked tennis anyway. Murray had said his summer's Olympic game would be his last event. Over the course of Murray's career, he won 2 gold medals in the U.S. Open once. He won Wimbledon in 2013 and 2016, the first of which made him the first British man to do so in 77 years. And that's your brief, John.
You did, or
Danny, thank you. Appreciate it. If the stuff's free, can you just walk out with it yourself? We should do a package on this. I'll do the camera work. You can go into, say, a CVS.
And
we'll see how much you can get away with.
And just, yeah,
And then go to a Lululemon, because this takes place at Lulu all the time as well. I see the same thing.
Why are you behind the camera and I'm the thief?
You're going to be, you want me to be the thief,
Yeah,
and you can be the
just in
camera
case.
person. All right, no, I was just going to make the package for you. It's going to do the hard work.
I'm staying out of this.
You probably don't want to get involved in this. I'm not sure management wants us to do it either. Up next on the program, the data in a driving seat.
I'm not worried about the state of the labor market. That said, the unemployment rate has moved higher. This is typically the tough part to really navigate, is getting that unemployment rate to move slowly up and not just shoot higher in an asymmetric way.
That conversation just around the corner. The jobs report, 45 minutes away from New York. This is Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
Counting you down to the jobs report, about 43 minutes away. The headline number, the expectation about 175. We'll get into those numbers in just a moment. Let's talk about the price action. Equity futures negative by more than 1 full percentage point. The bond rally continues. Yields are lower by 3 or 4 basis points. 393.76. Under surveillance this morning. The data in the driving seat.
I'm not worried about the state of the labor market. That said, the unemployment rate has moved higher. This is typically the tough part to really navigate, is getting that unemployment rate to move slowly up and not just shoot higher in an asymmetric way. So the next 6 months will be really important for the unemployment rate.
Here's the latest. Less than 1 hour until the July payrolls report. This marking the first of 2 jobs reports and 2 CPI prints before the next Fed decision in September. Neela Richardson of ADP writes this. Right now, the preponderance of jobs data shows a cooling but solid labor market. What's playing in the Fed's favor is how low the unemployment rate continues to be, so they can afford to be patient. Neela joins us now for more. Neela, it's good to see you.
Good to see you, too.
What a great day to catch up. Let's talk about the jobs market. You sound a little bit more constructive, dare I say a lot more constructive than some of the guests we've already spoken to this morning. You've got a load of data in front of you. Walk through what you see and why that gives you a little bit more confidence that this Federal Reserve has some time.
Well, first of all, we're still seeing hiring. And the hiring is robust, and the hiring is different than what it was 2 years ago. It's not just lower, it's less replacement hiring. Remember, this was the time of the Great Resignation. That meant if you had, for example, 30 employees and you owned a small firm, you might have seen 100 employees over a course of a year because your turnover rate was so high. We're not in that situation now. When a firm is hiring today, it's because they're trying to expand their workforce, not replace it. And I think that's an important point to keep in mind. Also, when we're looking at the unemployment rate, we are also seeing more people coming into the labor market, maybe lured by higher wage growth. So this jobs market is robust in some ways, and there are some concerns in the other. I'll just mention one concern that I have is how lopsided our job gains are right now, how positioned towards the service sector, and only certain sectors within the service sector are really seeing strong job growth. I think that is a concern going into the second half of the year.
So now people point to two things. Like you say, you're absolutely right that hiring is now more and more concentrated, which makes it more vulnerable.
Right.
And second, the nonlinearity of the labor market, that when it starts weakening, companies feel they're safer, if you like, to lay off people. Mm-hmm. The consumer gets more cautious, and then you start a process that's self-feeding. How worried are you about that second point, that it's a non-linear behavior when it starts weakening?
You know, I think companies are dealing with a lot of things right now. One of the things when I talk to companies they're dealing with is people aren't leaving. They're staying in role, and you see that in the JOLTS report. They're staying in role longer than anticipated. So companies hired coming into 2004 thinking there'd be more turnover than they actually saw. So the layoffs that you're seeing is not just a firm trying to right size because of margins or profit concerns. There's some of that. But it's also a correction to maybe overhiring a year ago or 2 years ago. So yes, there is a tendency for that employment rate to reflect weakness, but it must also reflect a little bit of self-correction on the part of companies as they're trying to right-size their employment going in, again, to maybe a weaker GDP growth and demand environment.
So take it to the data. We had a 4.1% unemployment rate. Mm-hmm. The Fed thinks we end the year at 4.
Right.
Where do you think we end the year?
I think we end the year around 4. I mean, I think that's plausible given the pace of hiring, given how strong consumer demand still is. It's fairly resilient, weakening in spots, but still overall good. And where you're seeing growth in the labor market is in those consumer-facing industries. So yeah, overall, I am constructive, but that doesn't mean that I have rose-colored glasses on this hot summer day.
I would just say constructive relative to the gloom that we've heard around this table.
Well, when you look at the labor market, like I have been for, through the pandemic, we've seen the highs and the lows of this labor market. We've seen very low lows. We've seen highs that were unsustainable. Right now, yes, it's a more normal labor market, but normal isn't always going up. There's a little volatility even in normal. Normal is dynamic in a labor market. And so that's what I think we're seeing in this particular one that is dynamic and very responsive to economic conditions.
We've just had a lot of doom and gloom on the show, people coming on using the R word. Danny was talking about before that even a 10% higher on the unemployment rate to go to 4.2% would trigger the SOM rule. How concerned are you about that, a tick up higher in the unemployment rate?
Always concerned about the unemployment rate, but less now than usual because I really think levels matter, and we started at a record low level of unemployment. So yes, unemployment rates are ticking up, but they're starting from a low level, and I think that gets lost in the discussion of the SOM rule. It matters where you start. And it matters where you finish. And if we're finishing at 4%, if we're finishing under 4.5%, I'll take that. That's very different than finishing at 6 or 7%, which has happened in other recessions. So that context is really important.
You've got some data as well, I believe, on job changes. You talked about people not leaving.
That's right.
What's happening with the wage growth that they can achieve from leaving if they wanted to, if they can find a job?
It's shrinking. In 22,
Quickly?
Yeah, very. In 22, 23, you could actually see maybe a 9% pay gap bump from your old job to moving to a new job. That's a pretty significant pay raise, especially if you're not making a lot. If you're in an hourly job in a consumer like retail, restaurants, leisure and hospitality writ large. And so the premium from switching jobs has shrunk, which is why people are staying in place longer, why the labor market is less dynamic, and why we might see less hiring over time.
Is that what we saw in job openings, the jobs data, the quits rate, the hiring data? Do we start to see some of that?
Starting to see that. You're not seeing as many openings. You're not seeing as many quits. Quits are down double digits from last year. And so there's no returns for a worker. The returns for switching have been getting smaller over time, and that's what we're seeing in the data.
Fascinating. Nina, appreciate it. Nina Richardson there of ADP, a Bloomberg contributor. I have to say, from my perspective, super rosy, given the doom and gloom. It's all relative. The doom and gloom on this program over the last 24 hours, Mohammed, we've gone from talking about soft landings just like that. Literally in the last 24 hours, it feels like consensus has shifted towards this hard landing story very, very quickly.
So is it the market leading the narrative, or is it the narrative leading the market?
I think it's the data shaping the narrative, and that's shaping the price action. I do. I've got to say, it's the economic data of the last 24 hours that spooked people. The employment component of ISM manufacturing, jobless claims getting to close to 250. The problem that I've got with this, Mohammed, and I think a lot of people feel the same way, we've had a few head fakes over the last 12 months. We've got claims the highest since August of last year. August was one of those head fakes, and then claims pulled lower again. Nita's talking about the dynamism of the labour market. I wonder if that's what's in store for us again. This is another head fake. 8:30 is going to be a big part of this story and how people write about this economy and this labour market going into next week.
Agreed. And let me just say, I wrote down, Ella, normal is dynamic in the labour market. I like that.
It's a great line. Coming up in the next hour of Bloomberg Surveillance, the third hour just around the corner, we'll catch up with Nadia Lovell of UBS, Robert Tipp of PGIM, Jeff Rosenberg of BlackRock, Dana Peterson of the Conference Board. Your jobs report is 34 minutes away. Your estimate is 175K. The previous month, 206 on unemployment. Big focus on unemployment. Does it carry on creeping higher? In our survey, we've got it down at 4.1%, in line with the previous month of 4.1%. Mohammed talked about the market narrative. It's running away over the last couple of days, that's for sure. And it's running lower. Equity futures down by more than 1 full percentage point on the S&P, and the bond market, the rally continues. The jobs report, 34 minutes away.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
In our eyes, it all comes down to the labor market.
The markets have definitely moved from worries around inflation to worries around labor.
The labor market can turn very quickly, which is why I think Fed officials have to be cautious as they watch these data.
A strong report's probably not going to prevent them from cutting, but obviously a weak one could.
I just feel like the risks on the employment side are increasing to the point that you want to put more weight on that.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Okay, we are 30 minutes away from the jobs report. Let's do one thing first. Let's check out the price action, then we'll get to the guesses. As for the price action, still negative on the S&P 500. We're down across the board. On the board right now by more than 1 full percentage point on the S&P. Down by 1.8 on the NASDAQ. Down by 1.6 on a Russell. The small caps pull in lower. Switch at the board and let's turn to what we're looking for a little bit later. Jobs guesses. 175 is the median estimate for the number that drops in 29 minutes' time. The previous read, 206. A big focus on unemployment. Hardly talked about wage growth. Just a big focus on unemployment and whether this continues to climb higher. 4.1% is the estimate in our survey, in line with the previous number. I can tell you one bank looking for 4.2. It's Citigroup and Andrew Hollenhorst. And Citi just published. And this is the title of the piece. And Mohammed, you mentioned this in the last hour or so, how quickly this conversation has changed. Citigroup today are looking for 150K. They're looking for unemployment to get to 4.2%. And the title of this piece today is 75 basis points of cuts for 2024 might be too few. How quickly has this story changed in just a couple of weeks?
Incredibly quickly. I mean, it's amazing. I'm absolutely stunned because consensus is moving so fast. I'm absolutely stunned.
Do you think it makes sense the consensus has moved this far? Is it validated by the incoming information that we've had over the last few weeks from corporate America and the economic data alike?
So I felt, as you know, it should have moved earlier than it did. It's taken time, and now it has moved. It's actually overshot where I am. When I hear people say 50 basis points in September, I think that's really, really difficult for the Fed to start a cutting cycle with 50 basis points. But that's where the narrative is going.
And you think that if they cut 50 in September, they've made a mistake?
Oh, absolutely. I do think they should have started cutting in July. But having said that, I wouldn't say now they should cut 50. I think they've got to be really careful to handle the start of this cycle. You know, you do impact behaviors. We haven't talked about this, but the major issue in the labor market is going to be behavioral. Are people feeling more insecure about their future income, and therefore are they cutting down on their income now? That's going to be the major question.
They're certainly cutting down on spending based on what we've heard from corporate America over the last few weeks or so. I've mentioned this calendar a few times. September 18th is the next Fed decision. At that decision, they also need to produce some new forecasts. And at the moment, they've got year-end unemployment of around 4%. They've actually got year-end unemployment for 2025 at around the same number. And that's basically where we are right now. For the data points still to come, after 8:30 this morning, August 14th, we've got a CPI report, another jobs report on September 6th, another CPI report on September 11th. A key feature, Mohammed, of your call, and you've written about this over the last few weeks, going into the decision this week, you said we were 2 decisions away from a policy mistake, including the July meeting and the September meeting. And the reason you said that was because you think this Federal Reserve could be pushed away from cutting interest rates based on one freaky CPI print between now and then. After that news conference, when the chairman kind of backed away from this view of saying we're not data point dependent, we're data dependent, has he done enough to convince you, after you blessed him with your thoughts on what the Federal Reserve should do, are you convinced that maybe he's seen your way of things?
So I'm glad he picked up on Christine Lagarde, the ECB president's phrase of we are data dependent, not data point dependent. And he stressed that by saying we look at the whole data. He kept on being pushed. You look at this, you look at that. He said, no, we look at the whole data. Look, John, in your series of dates coming up, let's not forget Jackson Hole.
Sure.
Because our star now becomes much more important. What is your destination? If people are pushing you to start the journey earlier, if they are building in quite a few cuts in that journey, what is your destination? And I think that the Fed needs to spend a lot more time thinking about the destination issues than it has so far.
We can explore that this hour. Coming up this hour, we'll catch up with Nadia Lovell of UBS as the stock market sell-off extends into Friday. Robert Tipp of PGIM, fixed income as risk aversion sparks a major bond market rally over the last 7 days. And Dana Peterson of the Conference Board on why she doesn't anticipate a hard landing. We begin with our top story, the payrolls report just under 30 minutes away. The first of 4 data points that the Fed will be watching ahead of September's rate decision. Nadia Lovell of UBS saying this: the Fed remains on track to start cutting in September with the economy on course for a soft landing. Easing financial conditions should be supportive to a further broadening out of equity market performance. Nadia joins us now for more. Nadia, good to see you. Before we talk about the call in the equity market, can we talk about the call in the economy? Soft landing was consensus for a long, long time, but it feels like things are changing quickly over the last few days. Why are you and the team sticking with that view?
Yes, we do think that the economy is slowing, but this is what normalization looks like. And when we heard from the companies throughout the earnings season, it does feel like things are slowing, but not necessarily deteriorating at a fast clip. So we still think that you can get economic growth in the 1.5% to 2% range in the back half of the year. We do think that the Fed will start to cut, and that will help the economy as we enter into year end, and that should be all supportive for the market. But there are data points coming out of earnings season that did give us some pause around the consumer. So we're watching that closely. But again, it doesn't feel like things are falling off of a cliff, at least not yet.
So what do you make of the change in the market narrative? What do you make of the fact that people have become so negative about the economy suddenly?
We are sort of in this regime again where we're shifting again where, good news is good news and bad news is bad news. And so it's clear to us, and I think to the market, that the rate cuts are imminent. Powell sort of blessed that, thanks to you as well, for blessing the September cut. And so the focus shifts to the data in terms of the growth data. Yesterday, ISM spooked the market, manufacturing, but reality is, manufacturing has been sort of been low on average 50 since late October of 2022, right? And to my understanding, the Fed had a preview of the ISM manufacturing data, and they didn't seem overly concerned with it. So again, I go back to things are slowing, but not deteriorating in a fast clip. And I think that the market, again, has gotten ahead of itself, particularly the rate markets that's now pricing in 90 basis points of cut this year. We think that it's going to be 50 starting in September and then another one in December.
So let me ask you about your distribution of potential outcomes. And I've put a soft landing at 50%. A recession at 35%, and then the really good scenario of bigger but not hotter because of positive supply shocks at 15%. So let's focus on the soft landing. Is it a lot higher than 50% in your mind?
I don't think it's much higher than that. But again, whether it's 50 or 60 sort of range, we still think that it's hard to see the economy go from growing above 2% in the first half of the year to then insignificant contraction in the second half, particularly when you have a labor market that, yes, is softening, but still producing job growth.
Nadia, you mentioned ISM yesterday. Reading through some of these responses, there's serious concern. One food and beverage company, consumer behavior is changing more than normal. Another company saying, we are hoping for an increase in customer demand, or we will possibly need to make organizational changes, i.e. layoffs. If you're viewing in a soft landing, what does it take for you to see in the data to potentially pivot and say, actually, this is going to be a hard landing?
I think you need to see, obviously, the labor market is quite important. We all know that that is the last shoe to drop. You are seeing a pickup in claims, but some of the data is quite mixed. I think some of the comments that you're seeing in the ISM has to do with reality is the consumer has been under pressure from inflation. I mean, food inflation itself has been up 30% since the start of the pandemic. So it feels like what companies are experiencing, they got used to the last few years of increasing prices and passing that on to the consumer, and the consumer just, continuing to spend. Now things are going back to pre-pandemic trends, and it feels like that companies have forgotten what that felt like.
One of your least preferred sectors, consumer discretionary. Does that speak to that?
So in terms of consumer discretionary, our view on that, it's less about the consumer. We just do think that the consumer as a whole is okay, particularly when you look at the wealth effect. You have the equity markets at all-time, home equity at record levels. It's more to do with the mix in terms of the sector being skewed more towards goods, and you're seeing a slowdown with that. You're starting to see, yes, some of that weakness translate into restaurants and even a pullback now on travel.
Airlines too, yeah.
Exactly, and even the high-end consumer throughout the earnings season, it feels like they're throttling back a little bit as well. So it's less more so about like, oh, we think that the consumer is really deteriorated, and more so of the fact that that sector skews towards more goods. Even home furnishing, this past week, down a lot as well.
Broadening. You're looking for broadening. Where's it come from? Who's leading it?
The broadening is more coming from some of the, I would say, in terms of some more value, cyclical value, if you will. Think about, like, whether you think about financials and them benefited from rates moving lower, them benefited from, Basel III endgame and sort of ease in regulation as well. So that's where some of the broad. Also, I would say even in the industrials, some of the more longer cycle industrials that are benefited from the increasing spending that we're seeing in AI, electrification, and automation as well. So the broadening that we're speaking of is not small cap per se, that I know has become a hot topic, but more some of the cyclical value.
So if you had looked at the S&P, there were three drivers of what has been strong performance. One is the notion that the sky is the limit for anything that has to do with AI. Second is U.S. economic exceptionalism that's going to continue supporting the broader market. And third, a responsive Fed. And over the last few weeks, we've seen all three being questioned and questioned in a significant manner. Looking forward, the repair process, where does it start? How far does it extend in terms of those three drivers?
So I think the Fed needs to start in September. The AI CapEx cycle, we are not, I would say I put more confidence in that than the other two that you spoke about. Because reality is, again, as you always say, listen to the companies, what have we heard this earnings season is that CapEx continues to go higher. Without commenting on single stock, if you look at Microsoft in their 10K, CapEx is be higher beyond 2025. So the hyperscalers are spending a lot of money, and they continue to emphasize that they're rather, like a Meta, Zucker has said, I'd rather have capacity that's not needed today than be late to that. So when we think about positioning in tech, we want to be positioned in those enablers. Those are geared towards AI infrastructure. And let's not forget the utilities are part of that. I think that's where some of the broadening out is coming from. So that's where we will put our confidence in, and sort of like, because at the end of the day, what matters for this market is earnings growth. We think it is going to be continue to be led by tech, and then sort of the Fed behind that.
It was a powerful quote from Zuckerberg, powerful from Alphabet as well, picked up on the same thing.
Exactly.
Nadia, it's good to see you. Thank you.
Thanks.
Nadia Lovell there of UBS on this equity market. This equity market is lower. We're down about 1% on the S&P 500. The jobs report about 17, 18 minutes away. Let's take the opportunity, just a minute or so, to get you an update on stories elsewhere. With the Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. The president and vice president were at Joint Base Andrews last night to welcome home Wall Street Journal reporter Evan Gershkovich, former Marine Paul Whelan, and other Americans as they arrived home. It was all part of the largest prisoner swap with Russia since the Cold War. In return for the Americans and other prisoners, Russia won the release of Vadim Krazikov, who's been serving life in Germany for killing a Chechen separatist. Germany had long resisted Krazikov's release. Chevron has made plans to move its headquarters from California to Texas. It is just the latest major company to leave the West Coast, complaining of excess regulation. It ends more than 140 years of Chevron in California. The company, though, does have already about 7,000 employees in Houston versus just 2,000 in San Ramon, California. In January, Chevron lashed out at what it called increasingly harsh regulatory environment in California, writing down the value of its assets in the state. And it is day 7 of the Olympics today. 7 U.S. teams compete across 5 team sports. In swimming, there are 3 finals on the schedule today. The attention turns to Caleb Dressel in the 50-meter freestyle race. In track and field, all eyes to Sha'Carri Richardson, the reigning world champion, in the 100-meter dash when she runs in the prelim of that event, plus the men's 100,000-meter final. And the U.S. is still leading the overall medal count, 39. 9 of them are gold. China has 12 gold medals and 26 overall. And that's your brief, John.
We've got a population adjuster table. I'm going to do that for you next week. Someone's going to do that. No one's going to do. Okay, we should do that then. Up next on the program, the morning calls, plus Robert Tipper-Peach in fixed income on the bond market rally heading into July payrolls. That payrolls report 15 minutes away from New York, your equity market lower. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
It's a question I've thought of, and a question I know that you at home in the office working away have thought of as well this morning. What happens if the jobs number is really strong? How does this conversation change? Ian Lincoln of BMO wrote this just yesterday. I'll share it with you now. NFP represents the biggest near-term risk event, even if it is decidedly one-sided, as investors will be quick to dismiss strength as status quo, while a sharp slowdown could be interpreted as a game changer for the Fed. We're going to find out in about 13 minutes' time. Equities right now on the S&P 500, negative by 1.1%. It yields down by 4 basis points on a 10-year, 393.76. Let's get you some morning calls. First up, Raymond James cutting Intel to market perform. The analyst saying AI PC growth has turned out to be a bigger headwind than anticipated. Intel's getting hammered. We're down 23% in early trading. Next up, Barclays raising its price target on Amazon to $235, keeping an overweight rating. The firm noting that web services, quote, deliver the goods, as Amazon faced an extremely high bar for AI investments. That stock is negative by 8.3% in pre-market trading. And finally, Citi raising its price target on Apple to $255. They keep a buy rating. The firm encouraged by early developer feedback on iOS 18 AI features, as well as management's confidence in AI-driven upgrade cycles. That's the story for the morning calls. The payrolls report just moments away. Treasury's rallying into the report as traders boost their bets for Fed rate cuts. Robert Tipper, PGIM Fixed Income, saying this. Exactly how weak is the jobs market? Employment statistics have been moderating, but not evenly. Non-farm payrolls have the potential fill or kill market expectations for a steady streak of rate cuts. Robert Tipp joins us now for more. Robert, I'll start with your own question. How weak is this jobs market? What are you expecting in 11 minutes?
I think that, the market pricing here is looking for rate cuts straight through the middle of next year. So this market is pretty much braced for a steady downturn in the job market that the Fed is going to meet with at least 25 basis points per meeting this year. And on average, we'll hit every meeting through the middle of next year. So, I don't know what's going to happen, but I can tell you that the numbers to date have hollowed out in terms of the cyclical aspects of the economy. There's more government, there's more healthcare. So you can make the case that seeing a big drop-off in the numbers today is to be expected, and that the Fed, if they get another set of weak numbers, just like 2 out of 3 of the last cycles, could end up cutting intermeeting.
Cutting
That's
intermeeting?
why they would do it. Intermeeting. 2 out of 3. Because if you think about it, they're at 2.5 on growth, 2.5 on inflation. Looking backwards, you could make the case, why on earth would they go intermeeting? Why didn't they just go? Because the numbers had not broken. But we have seen surveys that suggest things are going down. Their a priori is that they're restrictive, that the growth end of the mandate is at risk. They didn't hammer it. They stayed away from hammering it. But you had people at the meeting talk about, gee, should we be cutting here today? So if it becomes clear as you get today's number, which includes revisions for the prior month, and next month's number, often what happens is these numbers are, they break to the downside and are revised down out from under the outlook. And that's why you end up with these intermeeting cuts. I don't think that's going to happen. I think it's more likely that we have a very moderate slowdown, aside from any, hurricane side effects and that kind of thing. And that the Fed will, end up in a gradual string of rate cuts, and that we're going to have an orderly bond market that's range bound, albeit in a range that's a little bit lower on yields than what we've seen. But it is wide open. I think that's worth keeping in mind.
So, Robert, as John commented earlier today, we've seen a massive move in yields over the last few weeks. Where do you think the pain trade is now in the fixed income market? And if you can speak to both treasuries and credit.
Sure. Yeah, I think that we have seen these pain trades drive the market because there are so many powerful factors out there. We saw in September of last year, yields go shooting up to 5%, and they would have gone further. The economy was doing pretty well. The inflation was not under control, and the issuance was burgeoning. The Treasury issuance weighing on the market. The Fed stopped that with their verbal intervention. Right now, people are clearly worried about the bottom dropping out from under them like a 2008 scenario. Believe me, I do not think that's what's going on. I think the underpinnings here are solid. Could we have, very modest growth, a big slowdown to something subpar? Absolutely. But I don't think we're going to drop off like we have in 08 or like we saw in the 2001. But that's the fear. I think this is going to be a lot more like a 1995, where they get the numbers under control. They cut on a moderate basis. Because if you think about it, we've just seen a couple good inflation numbers. Before that, we saw a handful of worrisome ones. If it turns out things are moving higher, the Fed doesn't want to be wrong-footed in the other direction.
Hey, Robert, great to get your thoughts. Appreciate it. Robert Tipp there, PGIM Fixed Income, with a lot to think about. We often joke around this table that the jobs number we're about to get is the most important jobs report since the last one until the next one. Mike McKee joins us. And Mike McKee, I have to say, this jobs report does feel a little bit more important this time.
It does seem to carry a little bit more weight. I'm not going to say it's the most important one in our lifetime, but certainly the most important since the June report. This is maybe a turning point that we're at here, and that's what everybody wants to, as Robert says, fill or kill the idea, because if it is a turning point, then you're going to maintain the trade that we've had the last couple of days. And if we get a strong report, it'll be interesting to see what happens. And of course, the big question is our good friend Mohammed wrong in saying that the Fed had two meetings away from a policy mistake? Get a bad number today, it might have been just one meeting away from a policy mistake.
So, Mike, what is going on? A few weeks ago, everybody was comfortable. Yes, they can wait till September. There's no reason for them to rush. Now, suddenly, I'm hearing 50 basis points in September, intra-market, intra-meeting. What is going on?
Well, I think what you're seeing is the panic that one normally sees in markets, especially when there's turning points. As somebody once said, the Fed has a reaction function. Markets have an overreaction function. I don't think we're going to get 50, and I certainly don't think we would get an intermeeting cut because, well, first of all, one number isn't going to change anything in their minds. But I do think they're probably more divided at this last meeting than Chairman Powell let on. They all agreed at the end, but what did they say in the middle? We're going to have to check the minutes on that one.
Sintra Portugal, the ECB's get together, it really wasn't that long ago. It's about a month ago. And Chairman Powell spoke in Sintra Portugal, and he talked about the strength of the labour market as a reason for them to be patient. It gives them time to wait. I actually also got a sense of that in the news conference that you were in this week, that he didn't really stray too far away from that line. What would upset them today? You look at the jobs report, you look at the estimates in front of us, we get the numbers in a moment. What would upset them today? What would change that?
The biggest concern they have is the unemployment rate. They want to make sure that doesn't keep going up. 4.2% is their view of what sustainable unemployment is, where the neutral level of unemployment would be. 4.3% today would trigger the Somme rule, which would trigger a lot of fear, scare the horses in the markets. Non-farm payrolls, it would have to be a significantly low number because they've been expecting it to fall. They've been expecting us to gradually ratchet down to the 150s or 130s. So I think it's much more on the unemployment side. Hours and earnings are maybe affected by the hurricane, so we might not get a clean read on it.
We'll talk about Hurricane Beryl as well in just a moment. Mike's going to stick with us and break this down. Mohammed's going to react to it. Coming up, joining us, Dana Peterson of the Conference Board, Jeff Rosenberg of BlackRock. Up next on the program, the most important payrolls report since the last one till the next one. The jobs report drops next. The estimate 175, the number just around the corner.
covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The jobs report, 25 seconds away. The estimate, 175K. That's on headline payrolls. On unemployment, the estimate, 4.1% in our survey. Going into it, the scores. Equity futures down 1% on the S&P, on the NASDAQ down 1.7. Switch up the board and get to the bond market. Treasury still rallying. Yields lower by 5 basis points on a 10-year, 392.62. With the data, here's Mike McKee.
Well, here is a downside surprise that's going to catch the market's attention. 114,000 jobs created last month, according to the BLS. That is significantly lower than the numbers John was just giving you for what was anticipated. The unemployment rate, 4.3%. We hit the SOM rule with 4.3%. So that's going to really move some markets. Let me just give you a quick other numbers, and John will catch you up. Average hourly earnings, 0.2% lower than the 0.3 anticipated. That might be, we're going to have to check, that might be related to the hurricane. Same thing with hours worked, 34.2 down from 34.3. The 2-month net revision to payrolls is only 29,000, but 29,000 lower, and much of that seems to have been in June because that's revised down to 179 from 206. Manufacturing payrolls up 1,000. That is a surprise. All the pre-indicators, including ISM, suggesting that that was going to be bad news. And I know Mohammed's looking at the labor force participation rate, 62.7. That's up from 62.6 before.
Ladies and gentlemen, we have a growth scare. Let's get to the price action. Equity futures on the S&P down 1.5, on the NASDAQ down 2.2, on the Russell down 2.6. Want to see something dramatic? It's a word that gets overused on Wall Street, but this is a dramatic move. Switch up the board and get to the bond market. Front end of the curve on a 2-year yield. Look at this move on a 2-year yield. We're down 25 basis points. The 2-year is now below where the 10-year was only about 20 minutes ago. The 2 years down to 389. The 10-year at the moment down 18. We're down to 379. Mike McKee, what do you see?
Well, there's one note in this report that I think it's important to put out there, and that is the BLS says Hurricane Beryl had no discernible effect on the jobs data. So this is just what it is, and it is, I think, the way you characterize it, a growth scare is a good way to put it.
As you speak, Mike McKee, dollar-yen gapping lower, down by 1.2%. A stronger Japanese yen at 147.60. If you are just joining us, jobless claims yesterday, higher than expected. ISM manufacturing, lower than expected. The employment component spooked this market. And based on this, for good reason. Payrolls comes in at 114. The estimate was 175. Unemployment comes in at 4.3. The estimate was 4.1. And once I've given you that, you can guess what this market's doing. Equities selling off, bonds rally, and the dollar weaker. Mohammed, I want your view on this as well. What is your view on the totality of the economic data? And at 8:32 this morning, looking back at that Fed decision on Wednesday, how bad was that call to wait until September?
So I'm hearing the market scream two things, John. Growth scare, policy mistake. That is what I'm hearing. That is what you're seeing from the price action. I think the market now fully understands that the Fed may be late in starting its cutting cycle.
I do need to give one small correction here. We did not technically trigger the SOM rule because the 3-digit unemployment rate is 4.253, rounds up to 4.3. You would have had to have 4.8. I just plugged into my Excel spreadsheet the numbers, and we come out at 4.085. So we're very close to the Sahm rule, whether that matters or not.
Can I just say this market's trading as if we have triggered the Sahm rule and we're already in a recession? That's what this feels like, Mohammed. Is that what it feels like to you?
So Bill Dudley explained it, I think, really well, is the notion that all you need is people to start worrying about something, and then you don't actually have to have it happen. I think people underestimate the behavioral aspects when it comes to the labor market. I do worry, John. I've been worried for a while. You know that. I do worry. Now it's going to be really interesting to hear what Fed speakers say now that they're out of the blackout period, and what are they going to tell us.
Let's just take a step back, Mohammed. We've had growth scares before in this cycle. A lot of people have been humbled by how well this economy has held up. Why does this moment feel so different compared to all those other moments over the last few years?
So this is the first time that I have a growth scare. In the past, I kept on saying there's no reason for the U.S. to fall into recession. I think people underestimated the lagged effects of higher interest rates, and these are hitting in a much bigger way now. Chair Powell admitted on Wednesday, speaking to that. So, no, I do worry. I really do worry that we may lose U.S. economic exceptionalism because of a policy mistake.
Just to recap, if you are just joining the program, welcome. We got payrolls just moments ago, 114 against an estimate in our survey of 175. The unemployment rate climbing to 4.3%. The estimate was 4.1. That's unlocked a lot of weakness in this equity market, already on top of the weakness we've already seen. If we start with the equity board on the S&P 500, we are down across the board. Equity futures negative on the S&P, on the NASDAQ, on the Russell. On the S&P, we're down 1.8, on the NASDAQ, 2.5. Look at this move in small caps now, negative by more than 4 full percentage points. This was the trade in July, up by more than 10%. It was the big rotation, the broadening. We'd get lower interest rates, but we wouldn't get the growth scare with it. And that's what's changed in the last couple of days off the back of this economic data. And check out this bond market move. I want to keep going to the front end of the yield curve, the two-year. The two-year yield is lower by 26 basis points to 3.89. And once you've seen that board, you know exactly what foreign exchange is doing. Check out dollar yen. Dollar yen's had a massive week already. Yen strength, you get some more yen strength through this market. Dollar yen gapping lower on my screen to 147.35. To break it down, joining us now, I'm really pleased to say, is Dana Peterson of the Conference Board. Dana, let's go through this jobs market together. You've had about 6 minutes to go through the detail. What do you make of this? A lot of people around this table, including Mohammed Al-Arian, saying this is the growth scare and there's good reason for it. Do you agree?
I think there's a bit of an overreaction here. 114 is still a really strong number. I think we were used to these outsized numbers when we were recovering from the pandemic, where we know millions of people were let go, and then you had to recover them. So this is probably about normal for the labor market right now. And also, when you look at an unemployment rate of 4.3%, that is still very low. And what we're hearing from CEOs is that they're not really looking to let people go. They're holding on to their workers. And we have to remember, payrolls are a net number, right? And the thing is that on net, we're still adding jobs here.
So the reason why people say this may be different, and Dana push back on this, is that there are normal buffers for certain segments of the households. There are normal pandemic savings. There's very little credit availability left for them. That it's all about labor income. And if labor income starts falling, then you're going to get a much quicker sort of non-linear reaction in the economy than otherwise. So push back on this notion that the problem is that there are no other buffers in this economy.
Well, it's correct that the pandemic the excess savings is gone, but most people are working who want to work. Wages are still rising year on year, and they're still above what we saw during the great financial crisis and pandemic period. So yes, we are seeing people lever up on debt. All this is suggesting that yes, the economy is going to slow. That's what happens when you raise interest rates, and the goal was to lower inflation. Now the Fed is closer to its goal. Inflation's at 2.5%, but we're not there yet. And certainly there are a number of factors that are putting upward pressure on inflation. And remember, Fed Chair Powell said he doesn't want to see material further weakening in the labor market. I'm not sure that this report gets us there. And again, they're probably going to want to see next month's report also, plus the inflation data.
So Anne-Marie read out a few of the quotes that from yesterday's report about companies thinking, do we now have to realign our cost side, given what we're seeing on demand? How seriously should we take these comments?
Well, yes, I think some companies are probably running out of room to raise prices for customers, and that's the goal, right? The Fed wants companies to start cutting prices, which will help lower inflation. So on the demand side, everything is working according to plan. But the risk here is that you still have wages growing pretty aggressively, and that does raise labor costs for companies. And certainly smaller businesses are passing that right along to the customer. So that's leaning against the Fed's desire to get inflation back to 2%. So I think the Fed, certainly there's a signal that September will be the first cut, but I think the Fed will still move very cautiously, may spread out those cuts over time so that it can watch and make sure, yes, the economy is not going into recession, but also that inflation is slowing. Remember, inflation impacts everyone.
How can they move slowly and cautiously, though, if potentially they are behind the curve? A number of analysts came on the show today, Kit Juke, Sarah House, saying it would be a dramatic figure of under 100,000 for them to maybe go 50 basis points in September. Well, if you take into account the revisions as well from last month, we're basically there.
The revisions were small, and again, they were in June. And if you average out the second quarter, we roughly had around 100 and maybe 65,000 jobs added. That's a lot. And I'm not sure the Fed is behind the curve. I think the Fed has been moving cautiously. And even look at GDP for the second quarter. It was stronger, especially domestic demand, and consumers went out and bought cars, and they also continue to spend on services. So that's not really economy, certainly the second quarter, that I would say is collapsing. Now, we do think the economy will continue to slow. And again, that's according to plan. But as long as the labor market, we're still printing positive payrolls and the unemployment rate doesn't rise too much and approach 5%, I think the Fed can move cautiously and potentially 25 basis points for a meeting or even skip some meetings.
Dana, appreciate your perspective. A much more constructive view. Dana Peterson there at the conference board. As Dana speaks, some of these moves fade just a little bit, but a lot of it sticks. Equities are down hard. We'll start with stocks first. On the S&P 500, down 1.8%. The small caps down by 3.7%. Talked about this tremendous rally coming into the front end of the yield curve off the back of these numbers. Switch up the board and turn a page, and we'll look at the 2-year together. The 2-year yield is lower by 23 basis points at 3.92. Mohammed, we can talk about levels, and then we can talk about change. If you look at levels coming into this, 4.3% unemployment, payrolls of around 114. If we were sort of taking the last couple of years off and came back and looked at a jobs report like that, doesn't look terrible. You look at change. The change from where we were and where we are now, I think that's what the market's trading on. And you might, as an economist, sit here and say the Fed's not behind the curve. This market is trading as if it is behind the curve this morning.
It is. This market is taking change as much more important than levels. And I'm interested in Mike's view on this, because you were in the room, Mike, when the chair pushed back and said, well, look at the levels. Look at the levels. Do you think this report makes them worry more, or do you think that they think this is as planned? We're normalizing, nothing to worry about, levels are not that far out of whack?
I think you're probably right that they would say this is kind of what we're looking for. Now, it was a more abrupt move than perhaps they were looking for in terms of overall job creation, but the unemployment rate, while it sounded terrible at 4.3, it's a rounding issue, so it went up by about a half a point overall. And then you look at average weekly earnings, and on a year-over-year basis, it's significantly down. It's down to 3.6 now, and they have been looking for that. They've been wanting to get that below 4%. They've been wanting to get the inflation pressures, particularly in service industry jobs, back down to a level that they think is sustainable. So they'll see good things in this. The problem is to go back to what you said earlier, it only takes, you were quoting Bill Dudley, it's a confidence situation, and that's what people are going to be worried about, is are people going to stop spending, and therefore the companies have to lay people off, et cetera, et cetera.
Stay on the Fed for a minute. When they look at what's happening to the short end of the curve, will they think this is an overreaction?
I suspect they will, and it probably is to a certain extent, because the short end of the curve is pinned to the Fed. And so what people are saying is we think there's going to be a rate cut, but that was already sort of priced in. So now you're going way beyond where the Fed thinks it needs to be. And if they're already planning a September rate cut, this certainly pushes in that direction, then it shouldn't change the short end yields that much.
At the start of the year, there was one trade everyone wanted to put on, and it was the bull steepener. They were all looking for this massive rally at the front end of the curve and this big rate cutting cycle to begin at the Federal Reserve. And it's been delayed. And here we are in August talking about September. That was back in January, but I can tell you it's developing right now. The distance between a 2-year and a 10-year is down to about 11 basis points. So that yield curve inversion is disinverting, and it does so again this morning. If you're just joining us again, I want to recap these numbers for you. So payrolls comes in much lighter than expected, softer at 114. The estimate was 175. The unemployment rate climbs to 4.3%. The estimate was 4.1. Back on Wednesday, after the Federal Reserve decision and the Chairman Powell news conference, we caught up with Jeff Rosenberg of BlackRock, and I said to Jeff, how will we view this Federal Reserve meeting at 8:31 Eastern time on Friday once we get the payrolls report? And Jeff promised me his response. Jeff Rosenberg joins us now for more. Jeff, what is your response? How do we view that Federal Reserve meeting after seeing this data this morning?
Well, the data changes, and so does the view on what happened on Wednesday. You know, the big reaction here is that almost entirely across the board, this is a disappointingly weak number. So I'm very sympathetic to what Dana was saying earlier. The problem is that markets react to data relative to expectations, and so this is disappointing, particularly the lack of a hurricane impact. You know, there's your 20,000 additional right there. And the issue now going forward is what's priced into the bond market is 50 basis points of a cut in September. So it's this issue of reflexivity now that we're going to get into, and it sets up the Jackson Hole speech really importantly to try to calibrate what is the Fed going to do relative to bond market expectations. You had Dudley on earlier this week talking about how the Fed incorporates that. And if it's priced in at 50, does that mean that the Fed has to go 50? And so the pushback on that is going to be really important around Jackson Hole. But this is now starting to change. And Jonathan, you highlighted what I think is the most interesting market price reaction, which isn't in the bond market, it's in the stock market. And it's that Russell 2000 leading the way downward. So this absolutely, and you pointed out, that had been the rotational trade. If it's maintenance cuts and the Fed can just ease us into a soft landing, then the denominator is what's driving the movement into Russell 2000. But you see the movement today. Absolutely. This is about a growth scare. And now it's about worries that the numerator, earnings and growth and cash flows, are falling. And so you're fleeing the rotation trade into small caps. I think it's a really important observation of market reaction. We can debate whether this is overreaction or not, but the reaction is clearly to almost entirely across the board a disappointing report this morning.
So let's debate this, Jeff, because the Jeff I know would have faded this move in markets, would have been where Mike is, that this is an overreaction, especially the short end of the curve. Is that where you are now?
You know, when the data changes, you change. You know, what do you do? So, you know, I think we've had a little bit of a string here of disappointment on the data, and that's pushing more, you know, Mohammed, on your point about the lags of monetary policy. So it's hard to, you know, stand too far firmly against that. My points in the past, I think, are still valid, that you've had, you know, financial conditions, which we haven't heard as much about from policymakers in this cycle. Financial conditions have been much easier, and that has been supportive. But those financial conditions, as we're seeing today, can change, and they can tighten very quickly, and they can unwind. And so I think that the reaction here, you know, is probably the right reaction. All right, maybe it's a bit of an overreaction, but you're going to push on changing the trajectory from maintenance cuts to calibration cuts, that policy needs to move a bit faster.
So is calibration cut a 50% cut come September? What probability would you put to a 50 basis points cut in September?
You know, I think there's what the market wants them to do, and it's what they will do. I think they want to push back against 50 basis points. I think that's why Jackson Hole becomes important, to kind of get that message out, that the Fed doesn't want to overreact. So I'd put a little bit less probability on 50 basis points than what we're getting in the market today. So I guess that says short term, a little bit of an overreaction. But I think the market wants to push for the 50.
Jeff, I want to talk about this market in a little bit more detail. and talk about some of the things that I've heard over the last few months. The Fed put his back. And I've been told the Fed put his back because inflation is coming down and they have the ability to respond to adverse shocks if they need to. Another thing's come up in this program as well repeatedly, Jeff, and that there are two different kinds of rate cuts, and they're not created equally. You can cut interest rates because you've got disinflation and growth is still holding up, and that's great for risk. And you can cut interest rates because inflation is no longer a problem, but ultimately the problem now is the labor market. Jeff, do you think we've shifted to the latter? And if that is the case, can you make an argument for markets to do well in the face of interest rate cuts into year end?
Well, it was what I was highlighting. You know, you're mentioning the Russell 2000 performance. There's a shift here. You know, again, to Dana's points, you got to be careful. You talk about it a lot. The first reaction isn't the only reaction, but you're introducing into the debate a higher probability of policy mistake, into the debate that this is no longer about maintenance cuts, that it is more risk of the hard landing, as opposed to the soft landing narrative and calibration cuts that, you know, you can cut interest rates and that's a good story for risk. You're adding a bit more probability mass on the downside scenarios. Again, you know, it's one data print. It's relatively still strong, but the pace of change, I think, as we've highlighted earlier in this call, the pace of change is a little bit worrisome.
Jeff, so are you on the side that this is deterioration, not normalization?
Well, the kind of knee-jerk reaction this morning is clearly that this is deterioration, again, because the pace of change is kind of accelerating. And when you take kind of the totality of the week's data, it's all kind of piling into that side. Now, it's obviously affected by some other things. You've got the tech earnings side. You've got the Middle East uncertainty. So we have to be careful about kind of lumping all of the market moves into the economics. But clearly on the morning reaction, this is a reaction to an acceleration to the downside relative to that more expected consensus view around, you know, more gradual. So it is a bit worrisome in that regard.
Jeff, awesome to catch up, buddy. As always, Jeff Rosenberg there of BlackRock. Just got a note straight from Andrew Honhorst of Citi. Here's one for you. 50 basis points is absolutely on the table after the rise in the unemployment rate, with the SARM rule all but triggered and financial conditions tightening as equities sell off. The Fed may need to over-deliver on even the more dovish pricing now in the market. High inflation meant the Fed waited to cut rates, and now they may need to cut more sharply. That last line again. The Fed waited to cut rates because of high inflation, and now they may need to cut more sharply. We've had a conversation in the last 15 minutes. We've had one guest who's been constructive on the economic data in front of us, and they've talked about the levels. And then we've spoken to a market participant who's talking about the change plus the pace of that change. And Mohammed, it's the latter that's driving this market in quite a material way this morning.
It is, and I think rightly so, because we are seeing a rapid deterioration in the economy. John, I'm really glad you brought up inflation, because we have stopped talking about inflation. The assumption is that the inflation is conquered, and conquered per the Fed's 2% target. I'm not sure that's quite correct. I think inflation is conquered if you're willing to live with 2.5% to 3%. But if you're willing to live with 2%, we're not there yet. And that is going to complicate the Fed's policy reaction function even more.
Jackson Hole's going to be fascinating, isn't it? The speech that this chairman's got to deliver after a payrolls report like that.
If he's willing to address the major monetary policy issues, he may not want to do so.
Getting a lot of Fed speak through the next week or so, including a sit-down interview with Mr. Goolsbee of Chicago. President Goolsbee and Michael McKee. Mike McKee, I imagine that interview's changed after that data from 20 minutes ago.
Well, yeah, the first question might be a little different than in the past. I might let Mohammed come along and ask you. Hold up your column
fair,
from the other day.
He's been on the right side of this conversation out of everyone on the committee.
He has. The interesting thing, though, is what comes next in a month where there's maybe going to be speeches, although nobody at the Fed has speeches scheduled for next week. And we got to wait till the end of the month to hear from Chairman Powell. There's no meeting in the month of August. We have to go till September 18th. So if these numbers keep coming in poorly, then, you know, what does the Fed do about that.
You don't think we get any speakers between now and the end of next week?
Oh, well, I'm just saying we have the schedule for the Board of Governors, and they're on vacation, so you know, I hope they have a good time.
Mike, I have all the data points now between now and Jackson Hole. I'm thinking of ISM services, a few more jobless claims read, CPI print in the mix as well. When you look at the totality of the data, when you see notes like this from Andrew Honhorst and Citi, not a base case, but saying 50s on the table for September, you've been through a few of these growth scares in the past. I don't know where we're going to be by the time we get to September, but do you think 50s on the table for September?
I still don't think so, because I think that that would be read as panic. Now, obviously, they'll have another jobs report. If we get another 100,000, they're going to say, well, we have a lot of data in front of us. Let's see what that says. Markets have to price minute by minute. The Fed doesn't. So I think you're going to see some volatility in this, and they'll push back on that.
What do you think they do with the 4.0% unemployment rate by the end of 2024?
Well, that's something they're probably going to have to adjust. 4.1% is what they thought they would have, and we have just blown through that. We have to see if it comes back. Interestingly, got a note from Omar Sharif, who takes this stuff apart in minute levels, and he notes that most of the rise in unemployment was people who are on temporary layoff. Permanent job losers only went up by 40,000, and he thinks that we might see a reversal next month in the unemployment rate, in which case the Fed comes out and says, well, so we were right.
Mike, do you think the White House and Democratic leaders are going to turn on Jay Powell?
No, they won't turn on Jay Powell. They recognize that it's kind of out of their control, and we're talking about a very blunt instrument. You can't fine-tune the economy that well, but if we continue to see this and we don't get a rate cut, then they might. But you've already heard the governor of Illinois say Fed rate policy is slowing down companies. They can't.
We're going to hear more of that for sure in the next few weeks. Mohammed, just in the final 60 seconds, final word. What a morning, what a week, what a start to August.
Yeah, I thought what a week before today, and now are we just 2 days into August?
I know, seriously, it's August 2nd. Amazing. I thought July was exhausting, and August is absolutely exhausting. I want to run you through next week at the trading diary, because this is what it looks like. There's some important data on Monday when we get S&P Global PMIs, ISM Services, and the Senior Loan Officer Opinion Survey. Lots of Fed speakers well picking up through the week too. On Tuesday, we've got a US trade balance. On Wednesday, get more corporate results. On Thursday, another round of jobless claims. And Thursday and jobless claims is like the big data point alongside ISM Services for the week ahead. On Monday, what a lineup. Claudia Sahm of New Century Advisors, Sarah Hunt of Alpine Saxon Woods, Lindsay Rosner of Goldman Sachs, Andrew Honhorst of Citi. Sahm on the Sahm rule, Hollenhorst on the potential for a 50 basis point cut in September. Hello, August, I guess, from New York. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
All right, soft earnings plus a weak jobs report equals an absolute wipeout in futures. 30 minutes until the start of the cash trade. I'm Katie Greifeld.
And I'm Shonali Bassick. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, a sea of red. The global sell-off in stocks intensifies as a weak jobs report really adds fuel to that fire. Also, big tech troubles mount. Intel, Amazon, and Apple continue the string of disappointing results this earnings season. We've got an all-star lineup of guests ahead. Acting Labor Secretary Julie Su, BlackRock's Rick Reeder, and Bank of America's Savita Subramanian join us this hour. Let's take a check at where markets are trading right now because it is not pretty. As you can see on the screen behind me, S&P 500 futures down 1.5%. Pre-market, even worse if you take a look at big tech. The NASDAQ 100 currently off by about 2.2%. And the bond market, all the action is in the bond market once again today. You can see the 10-year yield currently down 12 basis points, Shonali. We are well below that 4% level.
We certainly are. And let's take a look here really quickly at some of these big tech stocks, of course, reporting earnings. We're watching big tech, Amazon, Intel plunging. Amazon now down almost 10%. Intel another 24%. Apple getting a drop lower by 1.4% despite getting a boost from its AI features. You have a worry here about that growth scare, but also about that CapEx spending. Let's look also at the big oil earnings really quickly here at the stocks pre-market. We have Chevron falling 1.8%, Exxon falling 0.6%. Remember, Chevron missed estimates and is announcing moving its headquarters to Houston. Exxon surpassed expectations, but being caught off in this market sell-off, Katie.
Yeah, it seems like everything is getting just thrown out with the bathwater today, and you've been so good on this, Shonali. The 2-year Treasury yield, just incredible moves. You take a look at that rate, currently down by 20 basis points. That, of course, comes after this morning's jobs data, coming in with a major miss to the downside. Let's break it down with Michael McKee. He is Bloomberg's Chief International Economics and Policy Correspondent. So we had a Fed meeting 2 days ago. Do you think that Jerome Powell is just wishing that he had cut rates now?
Well, we knew there'd be a risk element to this week because the jobs report was 2 days after their meeting, and it does look like risk went the wrong way for the Fed. And whether or not they think this is a terrible report, it does suggest that maybe they want to reconsider policy going forward. At least that'll be the debate on Wall Street. You can see the numbers, 114,000. The forecast was for 175. We had the last 2 months were kind of revised down, not much. But it's the unemployment rate that catches everybody's eye. It works out 4.3%.
All right, Mike McKee, thank you. We welcome now our Bloomberg TV and radio audiences because joining us now, I am thrilled to say we have Acting Labor Secretary Julie Su, along with our own Anne-Marie Hordern. And it's great to have you with us. Obviously, a big reaction to this jobs report. So we had a 114,000 increase in payrolls. You actually spoke to us back in June and said that we were looking at the definition of a soft landing. As you parse through these numbers, would you still say that today?
Hi, thank you. It's so good to be here. I mean, we, look at the 3-month average. The 3-month average in growth is still 170,000 jobs. Remember, we spent a year talking about how the numbers were too high and too hot, and we had always planned for a transition to a more sustainable, steady level of growth. This number did come in below expectations. It's still over 100,000 jobs. It's still broad-based. We saw growth in multiple industries. We saw it in construction. We saw it in healthcare. We saw it in leisure and hospitality. There was a dramatic drop in one industry, information. But generally, this is an indicator of continued strength in the economy. And when you look at other things, including labor force participation, which is at an all-time high for prime age workers, and we continue, know that there's continued work left to do to make sure that we maintain a strong economy. But we're still at a 3-month average of above the number that President Biden said a year ago we need to be to have a sustainable, strong labor market in a strong economy.
The unemployment rate came in at 4.3%, and Claudia Sahm has already said that this has now triggered the Sahm rule, which basically means we potentially are on the cusp of a recession. How concerned are you in the White House about that?
Well, we're not concerned about that specifically, in part because the unemployment rate that it grew from has been so historically low and has been so historically low for such a long time. I believe even Claudia Sahm herself expressed some questions about whether the rule applies when you start at 4% or just above 4% unemployment rate. So again, we have to keep in mind, these numbers come in not in a vacuum, but as part of a overall picture of an economy that we've been talking about for some time that did not happen by accident, that was not inevitable, in which there's been tremendous growth and an economic recovery that is frankly the envy of the world. And so we know that the work is not finished. We know that you don't get we don't stop doing the work that we've been doing. But one example of the effectiveness of the president's economic policies is that some of the growth is being driven by private investment into areas in which the president's Investing in America agenda has brought in public investments. And so those investments continue to hit the street. We'll continue to keep delivering them in different communities, and we'll continue to watch the numbers.
And of course, we're continuing to watch numbers. We're also watching the stock market reaction right now because we're seeing a big wipeout in futures. And the conversation that's happening among investors, among market participants, is this concern that the Federal Reserve is behind the curve, that they waited too long to cut interest rates. Is that the view of the White House as well?
I mean, we don't comment on Fed policy. I know they have, they've indicated plans and what they are likely to do. We still believe that this is an economy that, again, did not recover by accident, but also is one that reflects, the Biden-Harris commitment to working people. The real wages remain up over the year. They're still higher than the rate of inflation. This, as I've said over and over again, means more money in the pockets of working people. And some of the story that's not part of the labor market data is that we continue to see more workers join unions, more workers reach first union contracts, more contracts result in record wage increases. Those are all further indicators of what we believe is essential to a strong economy, which is that working people do well, working people share in the profits that they help create, and working people get a voice at the table.
We had Governor J.B. Pritzker, though, yesterday talking about the loss of manufacturing jobs in Illinois, calling on the Federal Reserve to move. If the White House is not going to take a stance, I imagine more Democratic leaders are going to come out and also say that this partially may blame the Fed because it is an election year and they don't want themselves to be blamed. How concerned are you that Fed potentially acted in a way that means that more Americans would be losing their job?
I mean, Manufacturing is a good example, right, of something President Biden has said from the very beginning, that we need to bring manufacturing jobs back to the United States. We need to make sure that the iconic industries like the auto industry that have powered this country's middle class continue to do so. Illinois is a place where, due to the UAW's historic contract, the President and I traveled to Belvedere, Illinois, talking about factories that are going to open that have been closed for a really long time. These reversals of decades-long trends that were not good for workers, that were not good for unions due to failed policy of the past cannot be reversed overnight, but we are seeing movement. And so that progress.
But Julie, many industries barely grew. Manufacturing, retail, information, all negative over the last 2 months.
If you look at manufacturing, since President Biden came into office, those numbers are up, and there's continued investments that we are making. If you look at construction jobs, those are also up. Those are two areas in which, again, federal investments are helping to drive that change, helping to drive that growth. And so we don't make too much of any 1 month, but when you look at the trend, those are both sectors that are up. Doesn't mean we don't have more work to do. Doesn't mean there aren't communities that remain devastated from failed economic policies of the past, that have failed working people, that have left working people behind. We remain committed to doing that work, and the overall numbers still demonstrate growth there, and we'll continue to put dollars into communities to rebuild them and bring jobs back.
And parsing through these numbers, it did seem that manufacturing payrolls did add 1,000 jobs last month, but to Anne Marie's point, that comes after 2 straight months of declines. I want to talk about revisions here, because on the top headline number, there was another revision to last month's number, and we've seen that increasingly over the past several months, that the prior month's numbers are revised down. And I'm curious what your thoughts are as to why that dynamic is unfolding, because again, the question among investors is, how do I trust these numbers?
Well, you noted at the top that this month's revisions were fairly minor. Revisions, I always say this too, are a feature of the numbers, not a bug. It's not an error. It's basically continuously these numbers get revised because it's the trade-off between getting out numbers quickly and getting complete numbers. So to get the numbers out every single month, as we do, it requires a certain amount of projection. And then once the real data comes in, because these are these aren't just numbers, these are actual people, right? They're people who respond to surveys. They're people who answer questions. They don't always answer them at the time that I come here to talk about it, and that's why we revise when we get the more accurate numbers. That has always been the case, and that is why the BLS data is the gold standard when it comes to labor market information.
If we have 4.3% today, where do you see the unemployment rate year end?
Well, I'm not going to make a prediction about that, but I will say, again, we look at everything in the context of the whole. And so GDP remains very strong. Layoffs remain relatively low. The labor force participation rate remains high. All of these are counter indicators. They're not indicators of recession. And so, of course, we keep an eye out. Of course, we have to keep on doing the work that we are doing. And we do want the economy to reach a state in which there's more steady, stable growth, and the 114,000 a month. There were in the last administration 7 months of numbers that were less than 100,000, and so again we're in a transition period. We've always said there would be. That was part of the plan. This number is cooler than expected, and so we have continued work that we need to do. And the investments in the President's Investing in America agenda are going to be really key to continue to power our strong economy.
Well, we have to leave it there. Really appreciate your time on this busy morning. Our thanks, of course, to Acting Labor Secretary Julie Su and, of course, Bloomberg's Anne Marie Hordern. And later today, catch our exclusive interview with Chicago Fed President Austin Goolsbee. That's at 12 p.m. Eastern. But don't go anywhere, because right now, Rick Reeder, he is the Global Fixed Income CIO at BlackRock. He joins us now. And Rick, my first question to you, has the Fed made a policy mistake?
So I think the price for interest rates is wrong today. I mean, should they have moved? I don't know that they were set up to move, given what they had told the market prior to this. That being said, if you're running, inflation is running 3-month moving average of inflation is pretty darn close to 2 by almost every metric. And if you've got slack building in the labor force, which we knew prior to this, 5 3/8 is the wrong funds rate when you've got inflation running at certainly low to mid 2s. So
Yeah, I think they're behind the curve, and I think this price for rates is not consistent with where the economy is today. Certainly not consistent with where inflation is today.
Rick, when you look over to September now, and if you look at market pricing too, it's starting to think so as well. Do you think that they're needing to go 50 basis points to really get caught up to where we're seeing the market headed?
So I don't know. I mean, there's data between now and then. I'm not sure today. If you ask them today, are they going to go 50? Listen, some of why you're seeing the increase in the unemployment rate is you're actually expanding the labor force. I mean, so much labor has come in to the labor force that's outpaced the amount of job creation, or quite frankly, it's getting those people integrated into the labor force. So I think the economy's still in pretty good shape. Is it slowing? Yes. Should the rate be lower? Yes. Would I do 50? I would do 50. I would have cut by June. I just think they need to get the rate to, if you got the interest rate to 4.5% quickly, that is much more consistent where the economy is and where inflation is today, and they should get there.
Well, let's talk about the reaction in the bond market, because the rally has been absolutely breathtaking. You take a look at the 10-year Treasury yield now, well below 4%. Rick, you and I spoke after the June numbers came out. We were at 4.4%. You think about where we are right now. Even with that in mind, what the Fed probably should do here, do you think that this rally has gone too far?
So what's pretty extraordinary is the markets have basically ignored what the Fed's saying. The markets have said, the Fed's behind. They're just going to have to get there. And so it's pretty remarkable how far the markets have come. I still think it makes sense to own interest rates. We talked about last time we were on. You keep owning the belly of the curve, hold this yield in the belly of the yield curve. How much the front end has moved for the Fed to fulfill that obligation, they're going to have to do 50, and they're going to have to move at every meeting subsequent to that. Listen, has the front end moved a bit too far? Maybe, but I'd still own the belly of the yield curve, and quite frankly, I'd still own yielding assets and hold them for 2024 and probably into the next year.
And speaking of the next year, you think about the play on duration here. If you're holding the belly, how do you feel, Rick, about the longer end of the curve, given that growth scare is the pervasive word of the day, and there's a lot of concerns about what an election could mean, what the fiscal situation of the United States could mean, and what Treasury issuance looking like into next year could mean?
I feel less good about it than I do the belly of the yield curve. I mean, the belly yield curve is the fulcrum point of where the Fed's got to go. Listen, the Treasury, like you said, it's got to issue an awful lot of debt. If you're a pension fund, you're an insurance company, you have liabilities trying to defease a liability stream. Would you match it longer out the yield curve? I guess so. But if you're not, I mean, the belly yield curve is where you want to be. I mean, I think the curve will steepen. Obviously, we've seen a significant steepening from here. I think it'll take some time. You see the demand in some of these corporate deals. You see the lack, when you take out the Fed's balance sheet, the lack of available supply in the back end. It keeps the curve flatter than it should be. But will it steepen? I think it will continue to steepen. I just think it will take some time.
All right, Rick, we are just getting started. Stick with us. We're going to take another quick check on futures right now because it's ugly. You take a look at where we're trading with about 15 minutes to go. 1.3% lower on the S&P 500, 2% lower on the NASDAQ 100 in the pre-market. Small caps just taking a beating here, down 3.3% pre-market. You take a look at some of the individual moves. That's actually shocking to look at in some cases. You take a look at Intel, down 24%, close to 25% after that disappointing earnings report last night. Amazon also down about 9% pre-market with big plans to spend, and NVIDIA continuing its sell-off, currently down about 4% pre-market. This is Bloomberg.
The names that move markets are on Bloomberg.
With all due respect and thoughts and empathy and sympathy for the people who are suffering at the moment, and there are plenty. It's not just Ukraine and Gaza, it's in many other corners of the world as well. But I'm constantly surprised by the level of resilience and the capacity to actually bounce back from those traumas. So I have faith in the human beings and their capacity to respond to adversity. We've seen it. You know, look, earlier in the pandemics, we thought that the world was coming to an end, right? It hasn't. Nobody thought that vaccines would come up in such a short period of time. And every time we have to constantly resurrect this spirit of resilience.
But are you hopeful that
I'm always hopeful. Oh, come on, we have to be. We have to be.
Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
A look at what's making headlines around the world. President Biden told Israel's Prime Minister Benjamin Netanyahu to agree to a ceasefire with Hamas on Thursday. The relationship between the two has been strained by the conflict as the White House's frustrations have grown over the continuation of the war in Gaza. And Vice President Harris raised a record $311 million in July, doubling Republican nominee Donald Trump's haul last month. The campaign for the presumptive Democratic nominee begins in August with $377 million in cash on hand, giving her the biggest war chest at this point in an election cycle. And Pennsylvania Governor Josh Shapiro has the edge in the race to be vice president, Kamala Harris's running mate in the upcoming presidential election. The 51-year-old has displayed agility and appeal. He could help to deliver a key state in the race and has consistently won his governorship with increasing vote shares, Katie.
And we're back now with Rick Reeder. He is Global Fixed Income CIO over at BlackRock. And Rick, I'm an ETF person. You increasingly are too. You manage the BlackRock Flexible Income ETF, ticker BINC. What's interesting to me is that you've held this consistent 40% allocation to high yield. And if we're in a situation where the Fed should maybe cut interest rates by 50 basis points in September, are you thinking about adjusting that allocation?
Not really. I mean, quite frankly, I think I said last time we were talking, high yield is not junk anymore. High yield market's in pretty good shape from a credit perspective. They term their debt out. So I still like owning high yield. What I like doing is owning it in yield, i.e., historically, you think about spread. A lot of people think about what the spread of high yield is. I mean, these yields are super attractive. Part of what I'm pretty comfortable with today, or very comfortable with today, rates are coming down. They should come down. And then if you just hold this yield, I mean, I think people a year from now are going to say, gosh, I got to buy high yield. I got to buy, like you were saying, I think we're creating almost 7% yield by buying some high yield, buying some investment grade credit, agency mortgages, creating some balanced AAA CLOs. Gosh, those yields are pretty darn attractive. In a world where the equity market's clearly more uncertain, gosh, clipping that sort of yield still feels pretty good to me.
Well, you are seeing finally a little bit of spread widening. They have been super, super tight. Rick, when you see spreads start to widen, where do you start to pick up more at this point? Do you have more of an inclination to even dive in, given that people do expect a rate cut at this juncture?
So, I mean, I like owning the assets, I think the comment, we own them, we like high yield, we definitely buy more. We'd like to see, quite frankly, the price come down. What's happened is obviously rates, treasuries just rally, the market moves up a bit, doesn't move up that much, so spreads optically widen out or actually widen out. I'd like to just see the price come under a bit of pressure, a la what's happened in the equity market, and then we would definitely add some more. I mean, I'm very comfortable. The technicals, people don't realize. You talk about total supply we get in Europe. I think we get 8 to 10 billion a month in European high yield. U.S. you get 20 to 25 billion. We're getting 400 billion a week of Treasury bills. We get 100 billion on average of coupon supply in Treasuries. There's just not that many bonds. in the high yield market. So I mean, I'm hoping they come under some pressure.
So Rick, you're waiting for those bonds, of course, to go on sale. What's going to cause that? If we haven't seen that sell-off start already, like we're seeing in the equity market, as you pointed out, what's going to be the catalyst?
The only thing, I think most people feel like U.S. economy, while clearly slowing, while clearly moderating, you know, it's still in pretty good shape. If you felt like we were going into recession or deeper recession, then would you start to say, gosh, I'm going to manage a bit more of my credit risk? I think so. But I still think we're pretty far from that. Even take consumer slowing, we see that. The labor market is slowing. You still have tremendous amounts of CapEx, R&D spend. Like we said, we're expanding the labor force. Part of why this unemployment rate is going up, you're expanding the labor force. That actually helps instigate better levels of nominal GDP. So if you felt like we were going into deep recession, which I'm certainly not seeing in terms of the data, then you would start to bring it down. But I think we're far from that.
Rick, I want to go back to the Treasury market here, because in addition to the moves that you've seen in the spot market, the swaps market also looks pretty drastic. Pull-up function WIRP on the terminal, and you now have traders really pricing in more than 4 rate cuts this year, including more and more of a possibility here of that 50 basis point cut in September. Goodness knows if we get there. Do you think 4 is even possible, let alone reasonable, or what would amount to 4 given where pricing is expected to be at the end of this year?
So I think it's somewhat ironic. If you ask me, I'd say yes. If you ask the members of the Fed, given what they are articulating publicly, I would think they would tell you no, or at least that's not their predisposition today. But yes, I think so. Like I said, I think you got to get the funds rate down to 4.5, and I think you should get it there. It's the wrong price today. So is it a possibility? Yes, it's a possibility. Listen, I think the Fed would still like to be deliberate. I still think they would like to see more time, more confidence. But would I do it? Yes, I think, and I think the markets are clearly suggesting to the Fed that it's time to go and it's time to move that rate down faster and more profound.
Square the square here for me, Rick, because if you believe that rates are still too high, what else breaks in this market as we wait for that first cut, even second and third cut?
So I'll tell you what's breaking. I mean, you see it play out today. I mean, the reason why the rate is clearly wrong is you look at the retailing data, the travel data, lower income is getting hurt by these rates. You look at credit card charge-offs, you look at loan delinquency, auto loan delinquencies, is a very consistent message across retailers, across travel, across auto. It's very clear that lower income, if you're a borrower, this rate is quite restrictive. What's happening in an economy today that's not that in aggregate that reliant on interest rates, but a big part of the population is, and that's what you're seeing. I know breaking, but you're seeing some pressure there, and which I would argue is too intense relative to where the economy is and clearly where inflation is.
Rick, we have 30 seconds left with you. Let's talk quickly about cash, because a lot of people are still happy to sit in cash right now. Is that trade over, though, as you think about what the next month or so could bring?
I mean, I still think cash deserves a seat at the table. I mean, when you got markets this volatile and you're still getting, because of the amount the Treasury has to issue, because where the funds rate is still too high, cash deserves a seat at the table. I think that seat at the table should be pulled a bit further from the table, if that's the right analogy. I think listen, would I lock in these yields and get a bit longer on the curve? We talk about the belly, I would. And you start to see that, certainly over the last month. You're seeing flows come in and people start to move out. But yeah, I'd still own cash. It's, it dulls beta that you see in some of the equity market, but lower than before.
Rick, we got to leave it there. Perfect day to have you. Of course, stunning moves in the bond market. That is Rick Reeder of BlackRock. Stick with us. This is Bloomberg Open Interest.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
DOJ or other authorities
could face bigger challenges next.
Was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
We are moments away from looking like it's going to be a brutal start to the trading day. This is Bloomberg Open Interest. I'm Katie Greifeld. Not quite a happy Friday, of course, in futures right now after a string of weaker than expected tech earnings. Then you think about the jobs report that we got at 8:30 a.m. and then you fast forward to an hour to the ringing of those bells, of course, at the NASDAQ, at the NYSE, and there is just red on the screen in the futures market. Going to be a really ugly end to the week if this holds. So let's take a check now on the major averages, because you have the S&P 500 currently off by about 1.4%, but big tech is really where you're seeing a lot of that pain. The NASDAQ 100 currently off by about 2% or so, but all of that selling, the real brunt of the action right now is in the small caps, your smaller companies in the Russell 2000 currently off by about 3.3%. But let's get back to earnings and 2 stocks to watch in the oil market. Chevron missing estimates and announcing it's moving its headquarters to Houston. Meanwhile, Exxon surpassing expectations after the acquisition of Pioneer. You're not necessarily seeing that in the share prices, Shonali.
Taking a look at the big tech names, also reporting Apple finally getting a breather, up actually at the open, about 0.6%, roughly. Amazon still dropping more than 9%. Listen, Intel dropping 25%. Katie, you're looking at the worst drop in more than 2 decades for Intel. We're going to cover these names and now a little more with Bloomberg Technology co-host Ed Ludlow here in studio with us. What's going on?
Yeah, I think you start with Amazon and say it's a continuation of the same story. Capital expenditures. The number's more than $30 billion for 1H, and it will be greater than that in 2H. And the response from investors, stock down 9.5%, is simple. They still don't see the translation to direct top-line growth, specifically from selling stuff that is AI. You know, AWS top-line growth 19%, exceeding expectations. That's great, but it's the money machine formula that we've been talking about all week. A lot of fun. The math ain't mathin' for some investors.
Even though with Amazon, you're seeing the bulk of the spending on AWS, right? Which, of course, is sort of the bright spot there. It's interesting to compare and contrast these reactions to what we saw from Meta, for example, because that was a stock where it seemed like investors were okay with that big capital spend.
So the point of absolute similarity is that you call it infrastructure spend or cloud. They're building data centers. It's an expensive enterprise. Meta's not a hyperscaler, but it does control its own infrastructure spend more directly. what they were able to show in Meta's case is that AI is helping the pricing on the ad side. So the core legacy bread and butter business is actually pretty good. In case you don't know, there's a social platform called Facebook, and it makes money with ads.
I've heard of that.
One was reminded of that this week. Yeah.
Listen, I want to point out here that the NASDAQ 100 falling 10% at the open means that it's sent to enter a correction territory here.
Yeah.
Intel today being the worst of the decliners in that NASDAQ 100.
Yeah.
Give us a little sense of how deep the pain is there. I mean, the drop you're seeing today is staggering.
This is very bad for Intel. It's very bad. And when the numbers dropped, the CFO, Dave Zinsner, phoned me, and basically the admission is that they had not, in a timely manner, adjusted to the reality of their revenues. Their core businesses are not doing enough to support what they want to do, which is move into data center. They're overexposed in the CPU market when what we just talked about is investment in GPUs. And so they have to cut headcount 15%, adjust OPEX and CAPEX, and make some very painful operating decisions to protect cash flow to change this business going forward. The turnaround plan, unfortunately, is not working right now.
And I have a great guest sitting to my left, but can I just say it's been so lovely to have you in New York this week?
It's been really good to sit here next to you. It's like Super Bowl week for me. And it happens 4 times a year, but it's been great. Yeah.
Back to New York every time for it.
Ed Ludlow, it's great to see you. That, of course, is Bloomberg Technology co-host Ed Ludlow. And joining us now, also, I'm thrilled to say, we have Savita Subramanian. She is head of U.S. equity and quantitative strategy over at Bank of America Securities. Great to see you in person.
Great to be here.
Let's talk about tech.
Oh, goodness.
It feels like for so long, at least the last couple of years, that tech has been the safety trade. When you would see an ugly jobs report like this, you just go into the big FANG stocks. Now we have not so great earnings.
Right.
Is tech still the safety trade?
Well, look, I think parts of tech are still a safety trade. And I think what we're seeing right now is pretty classic. You're seeing software, which is more defensive, hold up better than semis, which is more cyclical. We are seeing some of the more crowded areas of the benchmark get sold off harder. And I think what's interesting in tech is that companies that are beating on sales are outperforming companies that are beating on earnings. So it's not just about margin, it's about top line. But I think the problem is we're at a point where all these, these tech companies and the Magnificent Seven and this AI theme has been kind of buy the story, and now it's show me the money. And that's where we're seeing real differentiation between companies that are doing things well. As your former guest was pointing out, some companies are actually monetizing their CapEx. They're seeing better pricing. Other companies aren't, and that's where we're seeing this differentiation.
So where are you seeing the strategy behind some of these pullbacks? You look at some of the exuberance finally popped out of the market, but is there kind of more pain still to come given what we're seeing in the economic data?
What I think is very interesting is that if you look at cyclical pockets, it's more of a tech sell-off than an actual cyclical, kind of collapse. And I would highlight that within industrials, you're seeing machinery companies, which would typically do quite poorly if it were just an economic malaise story. Those companies are actually holding up better than semis, which is unusual. So I think we're actually seeing a bit of a trade down or a sell-off in secular growth as well as cyclical tech companies. And I think that's where it gets a little bit more interesting. I like areas like industrials because I think there is this strong and longer term story about a CapEx cycle outside of just AI and chips. There's, infrastructure and grid and bridges and, the entire US needs to be refurbished. But I think this tech sell-off is telling us that the secular growth story is maybe petering out. We are seeing more CapEx and less free cash flow. We're seeing, kind of the end of just this, wonderful period of cost cutting and just reaping sales benefits for tech companies.
Well, not to almost immediately go to politics, but you talk about that longer-term CapEx trend that you're seeing in the industrials. And I have to ask, if we get a new administration in November, now either way we're going to, does that potentially put that story at risk?
I don't think so. So we've done a lot of work looking at how much of this CapEx story is driven by fiscal stimulus versus just, kind of traditional spending. And I think there's an argument to be made that fiscal stimulus is not necessarily what's going to keep this going. In fact, when you look at fiscal spend as a percentage of total CapEx is just a tiny fraction of what companies, of what, you know, the overall capital spending and business investment story is that's taking place. In fact, I think it's less than 1/10 of total CapEx over the next 10 years. On top of that, you've got tech companies spending on old economy CapEx, you know, building out data centers and requires a little bit of, you know, other stuff besides just tech CapEx. And we've got an environment where both sides of the aisle are focused on bringing IP back to the U.S. and bringing jobs to the U.S. What does that mean? Activity in the U.S. has basically doubled from 2018 to now in terms of driving and, you know, moving stuff around, and that is taxing the infrastructure, which is already super old, right? I mean, you look at our economy, our manufacturing complex.
You take the subway.
Exactly. Take the subway as a case study in old infrastructure. You know, I think that's the story here.
I want to talk a little bit more, not about the fiscal, but the monetary as well. What would one rate cut really mean for the market? You have Michael Hartnett over at Bank of America as well. With you guys saying that the first rate cut should mean you should sell stocks. It would be a signal of a hard landing. How do you see this?
I think it's nuanced. So I think that this is a different rate cycle than prior rate cycles. I think the Fed is kind of, you know, at a point where they're trying to normalize rather than really juice up the economy. The economy is slowing, but I don't know if we're at a point yet where we really need to worry about a hard landing. I do think that we are seeing some of that nervousness around the economy playing through right now, and that might make the first Fed rate cut less extreme. In fact, the old kind of playbook is buy on the rate cuts, and I think that might be, you know, kind of more of a story for maybe next year. But, you know, our target for the S&P is 5,400, and we're sticking with that. We didn't raise it as the market shot past it. I would stick with it today unless we see demand, consumer, all of the attributes and business investment really fall off a cliff. So far, CapEx has been strong, and I don't think it's changing.
And just to go back to that point, buy on the rate cut, that was also supposed to be the playbook for small caps.
Yes.
And I'm almost scared to look at what the Russell 2000 is doing right now.
The Russell 2000 is a different animal than in prior cycles, and I think that's what we need to remember. The Russell 2000 used to be small, economically sensitive companies that would benefit from a growing economy. Today, it's half that, but also half a graveyard of old large cap companies that have refinancing risk.
Fallen angels.
Fallen angels, exactly. Those could do all right in a Fed rate cutting scenario because their refinancing risk is capped and mollified. But I think the idea of small caps just being this monolithic structure that's all going to do the same thing in a rate cut scenario is not necessarily the case.
Savita, stick with us. Of course, we're going to get right back to you. We're going to take a check on the markets, though, because, of course, as Katie has been talking about, we are looking at an ugly tape. We are looking at an S&P 500 down 1.3%. NASDAQ 100, 1.6% lower, really flirting with correction territory here. The Russell 2000 is just taking a beating at 3.5% lower. On the week, it's nearly 7% lower. We'll bring you more as we have it. Stick with us. This is Bloomberg.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change. In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity build in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg Open Interest. A quick check on stocks here. Of course, we're looking at a tough tape. A lot of red on the screen here. The S&P 500 down 1.3%. NASDAQ 100 looking at correction territory, 1.7% lower on the day. Russell 2000 down 3.4%. Katie down roughly 7% on the week.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Oppenheimer is upgrading Blue Owl Capital to outperform after the company saw its worst day in a year yesterday. The analyst sees a rare, attractive entry point for the company. Next up, Intel getting a downgrade, a number of downgrades today. HSBC cut its recommendation on the stock to reduce, while Raymond James downgraded it to a market perform. Now remember, the U.S. chip bellwether missed earnings estimates. It announced 15,000 job cuts, also suspended its dividend beginning in the fourth quarter. And finally, Wells Fargo analyst Mike Mayo downgrading Morgan Stanley to underweight, also trimming his price target. He cites caution over the bank's significant valuation premium, Shonali.
And back with us is Savita Subramanian, head of U.S. Equity and Quantitative Strategy at Bank of America Securities. And I want to ask you how you think about a day like today. You see the tech sell-off underway. Is this a moment to let it breathe? Or do you start to dive in and start to buy these dips in certain names?
I think you do buy the dip in certain names. I think this is a very stock-specific environment. So, you know, as I mentioned, I think we're in an environment where you really need to see that monetization story for AI play out. And we're actually seeing that. Some of the tech companies that have done really well over the last few weeks have been companies that have exhibited that ability to turn investment into profitability and pricing. I think there's also a big pocket of stocks that look very interesting right now, which is dividend yield. So let's say we're in a risk-off environment, which it kind of feels like. What does well when the market's tanking? You want to be paid in total return, clip a coupon. And right now, even with the Fed cutting interest rates, I think there is a bigger demand for dividend yield. Because if you think about all the cash sitting on the sidelines making 5%, that 5% is going to drop when the Fed starts cutting, and we think they start, later this year. Where do these retirees go for real returns? I know bonds are offering a pretty high 10-year yield, but on a real basis, that's really more like 2% if you take the yield and subtract inflation. The retirees need investments they can live off of, and dividends offer real returns. They're inflation protected, and I think that's a great theme to hide in.
On the CapEx story, you've been talking a lot about it. What do you think about this investor sentiment changing here around the CapEx story for big tech? Do you agree that it should be punished the way it has been?
Well, look, I think the big tech spending, the hyperscalers, is a huge chunk of CapEx, but even outside of that, you're seeing CapEx from other areas. And, you know, I think that we're kind of setting ourselves up for an old school CapEx cycle, because where we are now, we have extra activity in the U.S. The U.S. infrastructure actually receives a C- in terms of, you know, its health. And I think that's a huge liability for all of these cities and municipalities that are trying to court people and jobs and companies to move to their locations. So I think there's almost this must-do CapEx cycle just to keep that story going. And again, that gets political support from both sides of the aisle. Both sides of the aisle want jobs growth in America. They want manufacturing in America. They want IP in America. They want tech dominance. I mean, another reason that I don't think we're going to see a lot of regulation for these tech companies outside of consumer protection is the idea that the U.S. definitely wants to keep its pole position as the tech leader. And regulating these companies to the point where they are no longer competitive with other regions, I think is a hard to argue stance.
Savita, I want to go back to just the price action, because again, just watching this sell-off materialize in the S&P 500, also in the NASDAQ 100, it looks like we're down more than 10% from all-time highs. Correction territory.
Correction.
Could we be heading to bear market territory?
I mean, okay, so far our S&P indicators are telling us it's going to be okay. But we have a set of 10 indicators that we look at. 5 of them are flashing red. Usually ahead of these full-fledged bear markets, you see 7 or more indicators go off. So we're not necessarily at the point of absolute, you know, anathema for equities. I do think that part of the reason is that when you look at high yield investment grade, healthy and really kind of unusually healthy, maybe the cycle's a little bit different in that a lot of the lending and the low quality lending activity took place outside of the traditional lenders and really took place in shadow lending, private equity, private credit. Those are the areas I worry about from a kind of a full-fledged risk-off perspective. But I think that publicly traded U.S. equities, at least, are pricing in the current environment when it comes to rates, inflation. You know, private equity, private credit, unmarked, who knows? You know, it takes a long time for these things to really reveal themselves, but that's where I see more risk.
Oh, you are playing at my heartstrings with that conversation. Savita Subramanian, we have to leave it there, but what a day to have you, of course, that is Savita Subramanian of Bank of America Securities. And coming up, we're going to talk about JP Morgan CEO Jamie Dimon. He's calling for private sector representation in the White House. In his latest op-ed, is Jamie Dimon running for Treasury Secretary? We're going to discuss what's happening next in today's Wall Street Beat. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Open Interest. Let's take a quick check on this stock market right now. About 20 minutes into the session, still doesn't look too good. The S&P 500 down about 1.4%, more so on the NASDAQ 100, off by about 2%. But if you think that's bad, take a look at the small caps. The Russell 2000 currently off by about 3%, Shanali.
We're off of session lows, at least for the Russell, but it's looking pretty grim over there in the NASDAQ 100, of course, in correction territory, as you had mentioned. And it's time now, switching gears, we're going to talk about the Wall Street beat. Today, we're looking at Jamie Dimon's call for private sector representation in the White House in an op-ed in the Washington Post. He outlined a series of measures. Joining us now is Bloomberg finance reporter Catherine Doherty to talk about Jamie Dimon's call here and his motive. We'll talk about the actual specifics in a second here, but I do want to talk about the motive, because what does this all say about his mission moving forward? He has been much more intense about succession planning at JP Morgan, and realistically, he could be a Treasury Secretary at this point in either potential White House.
That's right. So the leader of the largest U.S. bank, he's not speaking like a banker. He's really sounding like a politician here, which is, I think, the tone of this piece is what struck me the most, is he's not calling on either candidate, really, or aligning himself with either party. He's speaking about the unity of what he hopes America will be in the future. And I think he's being very strategic about how he's coming across in this message, so that if either candidate is picked, no matter what administration we see in November, he could potentially take a seat as the Treasury for either candidate.
It's pretty funny, right? He's kind of playing both sides here, but of course not endorsing either candidate. What did he have to say when it comes to actual policies, though?
So he really focused a lot on economic inequality. He points out that there's a lack of policies with mortgages. He says that's a very simple fix. You could give those who have trouble or affording a home the ability through mortgages and just tweaking the economics behind that, which is something that possibly a banker would think about. That is one solution. He's also calling on the border policies to be tougher. He's calling on the stance with immigration, having just to take a harder stance and to develop policies that aren't so wishy-washy. Those are not his words. But I think that there was a call for just better policies and planning, and to be more clear going forward for either candidate.
And we should be clear also, all this Treasury Secretary speculation and talk, it's existed for a long time with Jamie Dimon. He's not the only one, by the way. Blair Efron over at Centerview is another person widely rumored to be a potential Treasury Secretary. And it's also not the first time, really, he's weighed in on public policy. He does this kind of often, doesn't it?
That's right. But this is the first time that I think he's come out with such criticism of just the lack of unity, and how there's not a clear candidate that is really pulling together the nation in this way.
Bloomberg's Catherine Doherty, we thank you so much for your time here. Of course, a very highly watched letter there from Jamie Dimon in the Washington Post. Now, also part of the Wall Street beat, want to take a quick check here on Ares Management Corp, dropping about 4% after reporting earnings this morning. Interestingly enough, the earnings beat expectations, but I did have a conversation this morning with the CEO on the impact of rate cuts. And something interesting, Katie, that he told me is that he thinks the capital markets, and I quote, will rip if you finally see those rate cuts. He says there will be a pretty significant amount of relief in markets, and that transaction volumes are picking up already in anticipation of that relief.
Yeah, I think a lot of people would agree with him this morning, especially in the public markets, too. I mean, you think about what we're seeing across the board when it comes to the indexes. We're going to continue to talk about that next hour with Max Kettner. He is HSBC's chief multi-asset strategist, why he isn't terribly concerned about a slowdown. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power. This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. We made it. The markets, though, may be a very different story. We haven't made it yet. We're close, but man, it is brutal out there if you were long equities. I'm Alex Steele, here with Jess Menton, because Paul Sweeney is off today.
That's right. I'm excited to be here.
Thank you for joining me. This is the perfect person to co-host right now on a day when equities are just getting smoked right now and a huge rally within the bond market. We have a great show for you, a lineup for you. Michael McKee will be here in just a moment to talk about the jobs data. Then we'll go right to Joni Biley, Chief Workforce Analyst at EmployBridge. Then we get the broad market breakdown with Gina Barton-Adams of Bloomberg Intelligence. We go with individual stocks. We're going to talk about Amazon and e-commerce with Poonam Goyal of Bloomberg Intelligence, as well as Matt Stuckey, Chief Portfolio Manager of Equities at Northwestern Mutual Wealth Management. It's a busy day. We got a lot going on, so let's get right to a biz flash right now with John Tucker. John?
All right, Alex, the stock sell-off continuing after the jobs report. The decline in Treasury yields, that is eye-popping. The 2-year, which we'll say is more policy reactive, 19 basis points lower. That is under 3.95 on the 2-year. You heard earlier today on Bloomberg Radio, Claudia Sahm saying the Sahm rule, the recession indicator, in her words, has been triggered. She says we are not in a good direction. The author of the Sahm rule also says the Fed should have moved the NASDAQ. That's in correction territory. Intel shares down something like, well, right now, 27%. The company delivering a grim forecast. This marks the stock's biggest intraday drop since at least 1982. That's over 40 years. Money markets ramping up their Federal Reserve interest rate cut bets to price in a greater chance of a 50 basis point reduction in September, plus more than 1 percentage point of easing by the end of this year. All the result of today's grim jobs report. S&P 500 right now down 87 points, a decline of 1.6%, 53.59 at the index. The Dow Jones Industrial Average 437 points lower. That is a decline of 1%. And again, the Nasdaq down 2.25%, down 426 points. Some of the individual shares on the move. Amazon shares 11% lower after their earnings result. And Apple, it's in the green right now, up 2.5% after their earnings report after the close of regular trading yesterday. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Jess and Alex.
He gets really excited when there's new people here. All right, thanks so much, John Tucker. I appreciate
just
that.
Forget everybody's name.
It's true. I've definitely looked at John Tucker and called him Paul before, so there is that. That happens. I just should point out the factory orders for June came out. They're down by about 3.3%. It is weaker sequentially and weaker than expected. Okay, Jess, here's my thing. I don't understand what normally we would have seen in a tech sell-off this week and what is really fundamental about the likes of, Intel.
That's right.
And Microsoft, for example.
Right. So I think there's a lot of fingers being pointed at much of the data points, say the manufacturing data today or the jobs data today, but a lot of the traders as well as portfolio managers, also hedge fund managers heading into what Powell was going to say on Wednesday, they were expecting kind of a sell the news type moment, especially when you think of particular areas, more speculative corners of the market, like the Russell 2000 that we know had took off quite tremendously, especially compared to its large cap counterparts last month. So when you're seeing this happen more broadly, some of them are arguing we're seeing kind of a normal correction here. And then if you're pulling forward those rate cut expectations, if you look at not just today, but also yesterday, you're continuing to see those sectors that are obviously lower volatility, dividend type paying corners of the market, like consumer staples up almost 1% right now. Real estate up about 0.8%. Utilities up also about 0.8%. We've talked so much, you and I, about utilities this year. It's interesting, if you look at the sub-industry groups, the ones that have taken off this year that are tied to the AI play, say like independent power renewables, those are down 4% right now. But water utilities, gas utilities, electric, those are all the ones that are powering that particular group higher. So you're seeing the other corners of those dividend players and income kind of stream proxies that have been taking, moving higher here. So the question is, a lot of people have been asking, of course, we've talked about this great rotation trade over, especially because that's been the whole argument the last year or so of hey, when is this going to broaden out? The S&P 500's top heavy, blah, 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 that kind of a thing. But you're still seeing rotation now. It's more, was that pulled forward so much when you're looking at those more speculative corners of the market, like small caps, and now you're seeing that rotation going into other corners that will benefit from rate cuts.
Right. Interesting, though, that small caps are getting hit that hard.
Well, also, it's the PE situation, because if you look at where it was priced before the rotation started for the Russell 2000 versus where it is now, the gap is the narrowest compared to the S&P 500. The only other times it was that narrow was coming out of the global financial crisis and then the dot-com bubble bust. So the argument there is like the PE equation of that. Now they've gotten a bit too pricey because the whole argument was, oh, they're so cheap.
Right.
So then what's the other side of that? It would have to be the earnings recovery, and that is still very elusive because, like you and I a couple weeks ago were talking about when they had the Russell rebalance in June, and then you had those big stocks that graduated when you're thinking about MicroStrategy and other ones like that. And because when you have the bigger players coming out, that creates an issue on the revenue side of things of what it means for that particular index. So then that equation is missing. So then you have people that will argue, okay, well, the Russell was a trade, not an investment. So you're seeing them pull out of that.
So we're going to talk about that a lot. We're also going to talk about jobs and the economic fundamentals and all that fun stuff. And for that, Michael McKee is joining us, Bloomberg Economics. No, you're not Bloomberg Economics. What? Senior policy correspondent.
Well, economics and policy. Whatever.
He does all things.
He has a long title. Like, that's the thing.
Boston Red Sox analyst for surveillance.
I mean, there's that too. Mike, I got to ask, are you surprised about the depth of the reaction? Like, people starting to talk about a 50 basis point cut in September, terminal rates being revised lower, the bond rally?
I don't. I don't ever get surprised by market reactions.
I love it.
And I've said this. I've said this before, and I'll say it again. The Fed has a reaction function. The markets have an overreaction function, and they always go too far, too fast, and then they come back a little bit to sanity at some point because you get a herd instinct when some kind of news breaks, and the markets were leaning towards a bad report, and so this just pushed them in a direction they already wanted to go. And I'll leave it to smarter people like Jess to tell you why they wanted to do that, but and whether or not lower rates are going to be good for equities or not. But at this point, I think it's today you just kind of look past what happened in the markets, and Monday you come back.
We can't do that. This is the fun part for us, but go ahead. Fair enough.
Well, Monday you come in and you start thinking about what does this mean for the overall economy. I'm telling everybody take Saturday and Sunday, just chill.
Don't call me in.
Yeah.
Well, we'll have actually Austin Goolsbee will be on Bloomberg Television noon, I believe. That's on our EcoGo page here. So when it comes to someone like that who's obviously on the Federal Reserve, what are you looking to potentially hear from him, and what do you want to kind of gauge here now coming out of obviously the Fed decision? And because he, at the beginning of July, he was kind of one of the first people that really, we know he's dovish, but he started indicating that he felt like cuts were coming pretty soon.
Yeah. Well, the chairman was very certain during his news conference that everybody was in agreement that they should pause. And I'm wondering if that's exactly true, or if he was maybe seeing what he wanted to see. And obviously the market is saying today that the Fed made a mistake. So do they think, how do they defend themselves to the idea of a mistake? And does this lock in September? And obviously, what do they think of a 50 basis point move? I don't think it's something that they want to do, so I don't think that'll be a big deal.
I mean, I know that the markets overreact and the Fed I get all that. But if the market starts to price in a 50 basis point cut or even an intermeeting cut, then the Fed has the enviable job of having to walk back expectations to kind of get that out of the market. How do they do that when they also have to acknowledge like things are getting weaker?
That's why they don't want to do that. They wouldn't do an intermeeting cut unless there was some real collapse in the economy. And we did get 114,000 jobs, which is not a terrible
And the Atlanta
number.
Fed GDP now for the third quarter is
It's
like
what the
around
Fed had
12%.
been looking for. They'd been looking for a more gradual ratchet down. This was a fairly dramatic move, but it's not out of it's not an abnormal result for the economy. And the unemployment rate is 4.3%, and that's still historically low. So yes, things deteriorated perhaps more quickly than they anticipated, but they're not going to panic at this point.
Okay, Mike, actually stay with us. Hang tight for this segment. We're going to bring in Joni Biley. She's Chief Workforce Analyst at EmployBridge, joining us now from Florida. Joni, give us your take on the numbers. Like, they weren't terrible. I understand the job market's slowing, but what's your take?
First, you can see that we have a cooling job market, and it's been coming for some time, over the last really even 18 months. Most of the job growth has been in the healthcare sector, in the government sector, and in leisure and hospitality. But there's been many sectors that haven't been adding that robust job growth. Manufacturing, professional business services has been struggling. The temporary help sector has really been struggling. So I think we're seeing more of the same, but this report showed some signs of real weakening. When you look at the unemployment numbers, that is certainly what concerns me the most, that we ticked up to 4.3%. We're up to 7.1 million unemployed people in the United States. And right now, I can't tell you that that's going to change very quickly. I think we're going to see more of that for the rest of this year.
What, if any, when it comes to inflationary costs, are driving people to go back into the workforce?
Oh, I think you are spot on when it comes to that. We are seeing people enter back into the workforce. So that that is a good sign. Even labor participation ticked up to 62.7%. So people are coming back. They have to come back to work. And that is due to inflationary costs. We're seeing people not only, need both parents maybe to work in a family, but some taking second jobs, looking for part-time work or maybe gig work to kind of supplement their incomes. So yes, unemployment will continue to grow as we start to see more people participating in the overall workforce. And unfortunately, job openings are starting to decline. Month over month, I think we're down to about 8.1 million job openings. And now we have 7.1 million unemployed workers. So, there's still more jobs than there are unemployed people, but that gap is really narrowing, and it could reverse that we will have more unemployed people than we do have open jobs in the U.S. in the next couple months.
One thing we saw in the report today that would be ordinarily even a red flag is a drop in temporary help services hiring. Basically, are you finding that companies don't want to add anybody at this point?
Yes, unfortunately, the temporary help sector has been hit the hardest over the last 2 years. We've been seeing declines in job growth for, I think since March of 2022. So again, this month is concerning. There was a loss of 22,000 jobs in this sector. And, it really points to employers are going to let their temporary workers go first and try to hold on to their permanent staff before they need to lay them off. And it has a profound impact on the overall temporary help industry. So there has been a softness across the board. Certainly I see it at EmployBridge. I'm also the chair of the board for the American Staffing Association, and I can tell you the entire industry is feeling it across the board. We're hopeful, as we look at coming into the holiday and the peak season, that employers are going to start adding to their payrolls, and hopefully 2025 is a much better year. But it would point to a challenging economic climate right now, and certainly concerns because employers are not adding temporary workers, to their payrolls.
Where are we still seeing bright spots within the labor force, Joni?
Well, bright spots, I will say, can still be in that healthcare sector. There's a tremendous amount of job growth in healthcare, and I expect those trends to continue. We have been seeing construction jobs start to come back. And if you look at the horizon, I do expect that we will see a resurgence in manufacturing. We're just not seeing that right now, but many plants are being, built across the country, and those jobs will come back in the U.S. I also think if you look at the breakdown of unemployment, certainly having education, college degree, puts you in a much better position. My concern in this month's report was actually those lower wage jobs, really not coming back and being eliminated. And when you look at unemployment, we saw the largest jump in unemployment in 25 years of age and older for individuals that have not completed their high school diploma. It went up almost a full point. We saw that shoot up to 6.7%. So those low wage jobs are certainly being impacted. College degree, it's still down to about 3.5% unemployment. So certainly lower than that 4.3%. So education, skills, experience, those jobs are still out there and in demand.
Is this something, the situation we have now with employment, that a Fed rate cut is going to fix?
It will certainly help. I think most employers right now are being very focused on, cost containment and where they're investing. And with where interest rates are right now, their purse strings are just a bit tighter. So when we talk to our customers at EmployBridge and certainly employers across the board, they are saying that they are waiting, for the Fed to cut rates, and that they're hopeful that when that happens, things will start to pick up and they will start to make those hiring decisions again and move forward. So I would say from everything we're hearing on the front lines, yes, that will help.
Joni, we only have about 20 seconds left, but we've seen when it comes to women and entering the labor force coming out of COVID, it's been a bit of a struggle more so compared to prior to that. But what are we seeing on that front?
Yeah, I think that there's more flexibility for women in the workforce right now than there's probably ever been before. Employers want to hire, a diverse workforce. They want women to come back. And they're offering more flexibility. So options are out there.
All right.
And I do think we're seeing women enter back as well.
Great to hear. Joni Biley, Chief Work Analyst here, and apparently the Chair of the American Staffing Association. And of course, Mike McKee, over our own at Bloomberg here.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. I hate to use adjectives, but I'll call it a vicious sell-off in stocks just met, and an eye-popping decline in bond yields, thanks to unexpectedly soft jobs report, lackluster tech earnings, and the S&P 500, 8 of the 11 major industry groups, they are lower right now. Biggest declines coming from consumer discretionary and information technology. Intel, worst performing stock in the S&P 500, down right now over 28%, just about 29%. The chip maker having trouble competing in the artificial intelligence era. These declines are something like close to a 50-year low. And the NASDAQ 100 today entering into correction territory. The futures trading implying the Fed's going to ease by a full percentage point by the end of this year, perhaps a 50 basis point cut at the September meeting. S&P 500 down 133 points. That is a decline of 2.4%. We're at 53.12 on the index. The Dow Jones Industrial Average down 698 points. The NASDAQ 100 down another 579 points. This is a 3% decline so far in today's trading. As for those yields, the more policy-reactive two-year yield, that is down 25 basis points right now, 389. The 10-year is 16 basis points lower. That is at 381. It's worth noting that inversion is now just 8 basis points apart between 2s and 10, negative 9 basis points. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Jess and Alex.
She's back. I left for a little bit. Did you guys know that? I went to TV, but I'm back now. Thanks so much, John Tucker. This is Bloomberg Intelligence Radio. I'm Alex Steele. Jess Menton is also here with me for the next couple hours. Paul is on the beach today. This is Bloomberg Intelligence Radio because we bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks because they cover 2,000 companies and 130 industries worldwide. And with a day like this, we really need a broad perspective. So we have Gina Martin-Adams, Chief Equity Strategist at Bloomberg Intelligence, joining us now. Gina, what should my takeaway be from this week in the equity market?
Yeah, I think there's a lot of moving parts, so you're right to try to take a bigger view. Obviously the market has weakened over the course of this week, mostly because of the macro data, but also because of the key tech reports, which were generally disappointing to very, very high expectations. Beside those two things, though, I think there's an important point that's kind of getting missed in the consensus and in the market volatility, and that is we are still seeing a better than expected recovery in profit growth outside of the Mag 7. So this rotation trade that has been in play is still in play. It may not be a full risk-on type of rotation trade, but it is a rotation out of the former leaders in tech and into something else. Today, that something else is more defensive segments, and it may remain more defensive segments until we get to that first rate cut because of the macro climate, which is pretty materially weakened, according to the data on both the manufacturing sector as well as the employment data that we got this week.
I want to give an update on the VIX. So it actually rose to 25 for the first time since March of 2023.
So didn't it happen like in the last half hour or something?
Right, exactly. So we're seeing that volatility pick up. And as you know, Gina, because you follow the seasonal patterns very well, so August, September, typically, traditionally the two weakest months of the year, but also you cover technicals very closely. From a broad kind of gauge here when you're looking at the S&P 500 or NASDAQ 100, what are the technicals telling us as far as when we're seeing the NASDAQ 100 in a correction at this point, how much more further pain technically could there be to run, or is most of that done already?
Well, I think that a lot of it will be driven by the fundamentals, frankly. I do think that the technicals are weakened materially for tech, but beyond tech, we're still trading near tops for most of the indices around the world. We've made new highs in Canada, for example. We're making new highs in developed markets outside the US. We're pushing to new highs for real estate stocks. So there's a really mixed picture. When you look at the full indices, yes, tech is the weak spot. And after it was the very, very strong spot, it's become the weak spot. And that's creating an enormous drag on the S&P 500 specifically. Beyond that, though, you've got all these tech adjacent segments like Amazon. That actually sits in the consumer discretionary sector, which is the weakest sector of the day because of Amazon's announcement last night. Is Amazon a tech company or a consumer company? It's definitely also weighing on the index. But I think when you look at the technical perspective, we're not yet completely oversold, and those are usually points in time when you see a bounce form. You like to get to a 14-day RSI closer to 30-35 before you get to a major oversold point where you can where a viable opportunity emerges on the index. And we may not get there with tech and tech alone. We probably need to see further weakness emerge beyond the tech and tech adjacent groups. I'd say longer term, there's no evidence that the bull market has turned over, right? And the index is still trading well above its 200-day moving average. Still nearly 80% of stocks in the S&P 500 are above their 200-day moving average. 70% of the stocks in developed markets outside the U.S. above their 200-day moving average. So there's just not a lot beyond the short-term technicals, the seasonal weakness, and now this macro data, which is really throwing a wrench in what was a pretty nice position for the equity market coming into the second half.
Gina, what about small caps? So we were talking about this earlier, Jess and I. She made the great point, like the valuation enthusiasm isn't as high anymore because it already ran. The earnings may or may not deliver. But typically, if the economy is bad and the Fed's going to cut and we're ramping up cuts, that should be good for small caps, no?
It should be, and we certainly saw that emerge, in particular in the S&P 600 relative to the Russell 2000. This is something our small cap strategist Mike Casper wrote about just today, is when you look at the dynamics of the small cap index, it would be really tough to say small caps went through a risk-on rip in July. As a matter of fact, it was the profitable segments of small caps that performed quite well, not the unprofitable junk.
Because there's so many zombie companies, right?
If we get to a point where the Fed does embark on a policy easing, you would expect some of the junk to start to perform a lot better. We haven't seen that yet, and I don't know that we'll see it until September. And that really reflects this broader lack of risk tolerance that has plagued the small cap segment really since 2021. We've been in a 3-year period in which small caps have just been the unloved sort of second fiddle to large caps, and there hasn't been a lot of optimism there. So I would say there's still not a lot of optimism in small caps. Yes, you had a tiny rip in July, but it wasn't a rip that would suggest that risk was really coming back on. There's a ton of room for small caps in an environment where the Fed starts to ease.
We appreciate you. Thanks so much. I know you're busy. Gina Martin Adams, Chief Equity Strategist at Bloomberg Intelligence. I mean, it's going to be really interesting, and this is a really dumb statement to say, to see how we open on Monday. In that, we don't want to take risk on over the weekend, right? So, I'm not going to blame anyone if we see more selling or into the close, right, or a higher VIX. You may not, but that wouldn't surprise me. But then is it going to be, okay, we had enough of a dip, we had the correction, let's go buy that dip, and what that conviction will look like come Monday morning.
Because we've continued to see that happen many times, especially since that October low of last year where people step back in, especially with these big tech stocks.
Yeah. All right. Really fun stuff. All right, let's get to Amazon. Is it a tech company? Is it an e-commerce company? I feel like this is always the question. Poonam Goyal is joining us. She's Senior U.S. E-commerce and Retail Analyst at Bloomberg Intelligence. Amazon stock is down by about 12%. I know it's a tough tape, so it's hard to really parse out. But Poonam, help me understand why the decline in Amazon.
The decline is largely due to the operating margin guidance, which came in below street expectations as they're investing more in CapEx, which is really on the AI side to support the cloud business. Now, you could argue that they did also talk about the consumer and it being weaker and it trading down. But I think, when the consumer trades down, Amazon can still do well and take share because they press the pedal on price and convenience pretty hard, which draws them the attention that they need.
So when you look at Amazon and MOV function, MAZN is the ticker symbol on this. So like Alex was talking about, down 12%. It's actually the worst performer in the S&P 500 and also dragging down the the consumer discretionary sector down over 5% right now. So when it comes to, especially when you think of spenders that feed into NVIDIA, because that was something that when it comes to those customers, because we won't hear from NVIDIA until August 28th. So a lot of people coming into this week were looking toward NVIDIA's customers because if you looked at, say, Amazon or even Meta, Alphabet and others who, if you combined their CapEx spending over the prior 4 quarters before this earnings season, it was around $150 billion. So the thing was, will they pull back or not? For the most part, we still saw a lot of spending. So I'm kind of wondering from that equation, Poonam, what are you seeing there as far as what this could potentially mean for a stock like NVIDIA? Because obviously this is more of a discretionary type company when it comes to Amazon, but when it comes to the spending, how do you parse that?
Sure. So for Amazon, the one thing you have to keep in mind that they were behind the AI wave, right? So they're investing more into AI than maybe some of their peers. And we think that's the reason that you're seeing a tick up in the second half from 30.5 billion in the first half. Now, when it comes to some of their counterparts, they've been ahead of the curve, and they could, depending on where their sales come out and where consumer demand is, they could continue at a steady pace or even pull back a little because they are somewhat ahead of the curve.
This is a super basic, dumb question. As they ramp up their AI stuff, how does that help them with e-commerce? Since that's such a huge chunk of their business. Like, I know that the AWS is the sexy growing part, but when you look at revenue, whether it's e-commerce or online stores, it's still double what AWS brings in. How does AI help that?
AI is actually a big, big deal in the retail space and the e-commerce space. So when you think about AI, what it helps them do is it helps them across all facets of their e-commerce business, whether that's search, right? So you go into the Amazon search bar, and let's say, you're used to typing in, I want a black dress. But now you don't have to. You can say, going to a black tie event, right? And they should be able to populate dresses that go with that. So conversion is one of the biggest pain points in e-commerce. You're going online to browse more than you are to buy, whereas you're going in store to buy more than you are to browse. So I think as what AI can do in a meaningful way is improve conversion, because you can get the results that you're looking for faster. You can improve the shopping journey. You can get customers to find what they want more easily. And not just that, right? They're using AI not just for the search, but they're using it in customer service. They're using it for inventory. They're using it in their automated shopping platforms like the Rufus or the Alexa. So there's a lot that's happening with generative AI, especially, which we think will help drive retail higher for a long time.
We only have about a minute left here, but you've talked about also how, when it comes to the margin equation for Amazon, how you're seeing that expanding over the long term. And as you know, Alex, when you think of the discretionary sector, the margins coming out of COVID, that was such a big issue because of the inflationary pressures. So I'm wondering, Poonam, when you're thinking about that, because if you're not an Amazon or maybe like a Home Durable, like a Home Depot, a lot of those other retailers are struggling. So what are you seeing from like the margin aspect, maybe more broadly, or what can Amazon tell us kind of moving forward, what that means for discretionary type of companies in the retail space?
Sure. So remember, Amazon's a retail company, but it's also a tech company.
Right.
And the margin opportunity for Amazon really comes from the tech side. So the cloud business, which is about $100 billion, we estimate that going to $200 billion with a 40% margin. There you go. You just added another $40 billion in profit. And then when you look at the advertising business, $50 billion run rate going to $100 billion, which we think carries higher margin than AWS, you're looking at adding about another $50 billion at the minimum or more in operating income. So right there alone, you're reaching about $100 billion in operating income in the next 5 years, additionally to what you have today. And that's the profit driving part of Amazon. And you can argue that ads are supported by the growing retail business.
Poonam, we got to leave it there. We're up against a break. Thank you very much, Poonam Goyal, Senior EU.S. Commerce Analyst for Bloomberg Intelligence. Coming up next, we'll continue on these markets. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker of the Bloomberg News with this Bloomberg Business Flash. Recession fears front and center after that lousy job report this morning. Bond yields plunging. The NASDAQ, that is in correction territory. Economist Claudia Sahm telling Bloomberg Radio her SOM indicator, it has been triggered. That is a recession indicator. The major stock averages continued their sell-off from yesterday. It isn't helping that tech earnings disappointed. Intel is looking at one of the worst declines in close to 50 years. Amazon also off to a rough start. The online retail giant reporting revenue that came up short of expectations. Intel shares, they are down 28%. Amazon shares, 12% lower. One of the bright spots after the report, earnings report after the close of regular trading yesterday, Apple shares, they're bucking the trend, up 2.25% right now. The major stock averages, S&P 500 down 2.5%, down 137 points. We're at 5308 on the index. The Dow Jones Industrial Average down 785 points. That's down close to 2%. And the NASDAQ 100, again, in recession territory, I should say correction territory, down 597 points. That is a decline of 3.2%. The two-year yield, 24 basis points lower. That's at 390. The 10-year yield, 15 basis points lower. That is at 381. Trust me, that is eye-popping. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Jess and Alex.
All right, thanks so much, John Tucker. Bloomberg Intelligence Radio. Alex Steele, Paul Sweeney's off on the beach. Jess Menton is here, as well as John Tucker. Yeah, we haven't seen those chunky moves in the bond market in the front end since, guess when? Oh, 2023, March. Little SVB action there. So just for perspective on like the type of sort of panic buying, if you will, coming into the front end.
Also, though, Atlanta Fed GDP now for the third quarter coming in around 2.5%. And then the ECFC function in the terminal, that's where you can see the economic forecast for GDP annually as well as quarter over quarter. Still seeing strong growth here. So I know people are potentially spooked by this job number coming in below 150,000. But again, when you're looking at some of the economic projections here, still pretty strong growth here overall for the U.S. economy.
It's such a good perspective, which begs the question then, when you have a sell-off that's triggered by that growth scare, what do you do then when the underlying data is still okay? Well, Matt Stuckey is Chief Portfolio Manager of Equities at Northwestern Mutual Wealth Management, and he joins us now. So to that point, when you see the NASDAQ off 3%, do you buy the dip?
Well, good morning. Thanks for having me. Look, I think before you rush into any kind of buying and selling activity on a day like today, revisiting kind of where you're at from a risk allocation is probably where you need to start. And so if you're way underweight risk assets, maybe today's a better entry point. But again, I think it's important to always kind of center whatever trading activity you make based on kind of your long-term risk tolerance, because that's likely to be tested in the coming months.
So how are you advising clients to position? What are you suggesting that they buy? What are you suggesting that they sell when it comes to equities?
Yeah, within equities, look, I mean, we have been somewhat vocal about our concern about concentration building in the S&P for the last year or so. And to kind of counteract a little bit of that growing risk, you know, we've recommended clients kind of use a little bit of a value tilt within their portfolio in the S&P space, maybe an equal weighted exposure as well to mix in some diversification. You know, we also have been somewhat positive about the optionality that we think exists in U.S. small caps and mid caps, where, you know, from a valuation perspective, prior to July, you know, things were fairly compressed and dislocated versus the S&P. And we thought it could work in a variety of economic outcomes, one being a mild recession, which kind of catalyzes some aggressive Fed rate cuts, or you know, a soft landing scenario, which still allows the Fed to cut maybe just by less. That broadens out the economic participation in today's economy. You know, at this point now, though, you know, I think we got to have a longer term horizon for that to play out, because it does look like incrementally the labor market is accelerating to the downside, and we're likely to be in some choppier waters here for the next few months.
So you mentioned the Russell, and now we're looking at the Russell down over 4%. We haven't seen this kind of slide since June of 2022. I mean, I appreciate that it's looking for value is interesting. How do you manage then We had a minor run up, and then here we are, down again the most in 2 years.